I'm this freshman in college heading the sophomore year, and like all this money just came in.
Meet Ted Zhang, a trader that manages $30 million at just 25 years of age. He manages capital as part of Revere Asset Management that manage over $400 million.
COVID hit spring of 2020. All of us were sat home. My curious mind just instantly got hooked on the markets. I was doing Uber Eats, DoorDash. That's how I started like that first $5,000-$10,000, which I just plunged all into the markets.
And what was your gain like 2020 through 2021?
I don't have the exact stats, but it was at least like 15 to 20x. I dropped my acceptances. I was gonna head to actually Columbia Dental Medicine here in New York City.
What does risk mean to you in the markets?
Essentially, to me, risk is the potential to lose money. Your risk management habits determine if you survive in the markets or not. You have to ask yourself why you want to get in the markets. You have to have that natural inclination for it, or else you're gonna give up and quit.
What kind of style did you develop after that 50% drawdown?
I would describe my style now as the biggest principle Don has instilled on us is, he says this all the time, he who has a why to live for can bear with almost any how. So if you truly have a good why, like the how, you'll figure it out. Really, I'd say the biggest turning points on
All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moblin. With each episode, we strive to bring you market wizards, top traders, and U.S. investing champions and share insightful and actionable insights. This episode is brought to you by public.com. To learn more, go ahead and click the link down below in the description. Joining us today is someone who I'm really excited to speak with, Ted Zhang. He's a portfolio manager at Revere Asset Management, which currently oversees over $400 million. And at only 25 years old, Ted co-manages the Turbotecction portfolio, which has 30 million AUM. And today we're going to dive through his full process, routines, books that made a big difference in his trading journey, and all his secrets and rules. So Ted, great to have you here. Welcome. Really excited for this. So thanks for your time.
It's finally nice to meet you in person, and I'm really happy to be here.
Yeah, sweet. I know we've got a lot to cover today. We're also going to dive into a bunch of recent key trades where you're going to really show how you actually go through your process. But to start with, let's bring it all the way back to the beginning. How did you first get into trading the markets, and when did you kind of decide that was going to be the career you wanted to pursue?
So I went to college to study biology on a pre-dental, pre-med track, and my goal is to become an oral and maxillofacial surgeon. So that's what I studied throughout college. I finished that degree. I eventually received my acceptances to dental school. But to step back, COVID hit spring of 2020. All of us were sat home, and my dad just had CNBC in the background. And my curious mind just instantly got hooked on the markets. I think my first purchase was like a share of Boeing and then a share of Tesla, but I had no rules at the time.
And this was in 2020?
Yeah, 2020, spring, like May of 2020. That was during my spring semester of freshman year. So we're finishing up freshman year, and I got into the markets. First share, like I said, Boeing, and then some Tesla. But I didn't have any rules, no buy rules, no sell rules. It was just buy random stocks. So continue on, just like early phases of my trading. I didn't really know anything that I know now, like technical analysis, risk management, position sizing. My first edge was in SPACs. Yeah, special purpose acquisition companies. And at the time,
Which were huge at that point.
We had this crash. Everyone thought the world was going to end, and the Fed and the government just printed trillions of dollars and injected in the economy. So, money needs to find a home somewhere. And oftentimes when they print that much money, it finds homes in unwise situations.
More speculative areas.
Yeah, potential frauds. We didn't know that at the time, but it seemed like this great opportunity. All these SPAC sponsors and founders are saying it's like venture capital for retail. That's how they sold it.
Yeah.
And it's funny. I think that's when TikTok was first starting up too. I'm off TikTok now, but there was this TikTok promoting VTIQ, which eventually merged into Nikola. Mm-hmm. So that was like the first big trade. Intuitively understood that SPACs wouldn't go below their net asset value, which is $10, until after the de-SPACing phase. And so my strategy essentially was SPACs went through this process of like looking for a company to merge with. There's a definitive agreement, eventually like the shareholder vote, like the proxy vote to merge the company. And I noticed the pattern where there's a lot of speculation and people doing like deep due diligence on X, and that's how I first got on X too. And you can accumulate these SPACs around $10 a share, and eventually get these pops when they announce, a stock potentially merging with the SPAC in a hot theme. Like EVs were a hot theme at the time. Nikola was like,
Yep.
this like next Tesla. That was like the frame of Nikola. So that was the first big trade. And I'll just fast forward a little bit. There's a bunch like Hyliion. I forgot that was from SHLL. Chamath had his whole SPACs from like IPOA, and he wanted to go through all the way to Z. Yep. So he knew something was quite frothy. And a big one was CCIV into Lucid Motors, which is actually like still around, but I don't think it's doing well. I haven't looked at the stock in a while. And that edge all ended. I mean, these temporary edges due to like macro and frothy conditions usually always come to an end because it's not rooted on timeless principles, which we'll definitely get into in your book and all the other books I've read. So that ended February of 2021. And it was like a shock because it ended and the edge was gone.
Yep.
And at the time, so, I mean, I did really well. Like, pretty much haven't ever seen red negative in the career, but like I would still consider a blowout. Like it was probably 50% drawdown.
From your highs at that point, from 2020 through 2021, and then a pretty significant pullback.
Pretty significant pullback. And afterwards, I didn't really know how to trade the markets. Yep. It was decent timing because I had to study for the dental admissions test into summer of 2021. So it was like a forced hiatus, which was probably good. But, you know, I was already I was super happy with like the results because I'm this freshman in college heading the sophomore year, and like all this money just came in. Even though the pullback happened with the correction, like I still framed it seeing I literally started from nothing. Yeah. And the starting capital, I also captured the opportunistic like event during COVID. Everyone wanted to order Uber Eats and DoorDash. So I was doing Uber Eats, DoorDash, and then listening to a lot of podcasts at the time to like make use of my time. I did some, what was it called? Instacart as well. Mm-hmm. And that's how I started like that first $10,000, which I just plunged all into the markets.
And what was your gain like 2020 through 2021?
I don't have the exact stats, but it was at least like 15 to 20x. Wow. But then it all came back.
And then the 50% pullback. How did that feel, that first 50% drawdown? Like, and
it was more like 10, 15x.
To start, and then that 50% drawdown, was that like all at once within a few months?
No, it was paper. So yeah, it was all just paper cuts. Mm-hmm. Yeah, just over time. Because the dental admissions test gave me that hiatus, so I didn't completely destroy myself. So took that test, spent like 500 hours studying it, did really well on it, and then that was a big like check mark for me out of the way for like my dental process. So continue on. That's when I found how to make money in stocks. Yep. And Connor, who I manage money with right now, actually introduced me to that book. So I read all of that, and then that started giving me a foundation. But as you know, if you don't put it to practice for a long time, you're still not going to get it. Like it's theory, you read it on the page, but that doesn't mean you actually get it and you can execute on the principles. Yeah. So this was junior year now. I finished my applications heading into summer, now transitioning to senior year. Sent it in the first day because that was like the best thing to do. And then that's when I so I've been following you for many years before. And that's when I was like, okay, I got to do something with my summer. I love the markets. I love trading. And I just sent you a cold DM. And then you replied. And then I did like a non-paid internship with you guys. I just asked for free work because,
to learn.
Yeah. You don't know me, and I'm fine just getting experience and learning. And I mean, it was a great summer. I helped you guys do some content for Stan Weinstein's course, and now stage analysis is a huge part of my process and now how I like approach the markets. So after that, and I think you probably gave me time of day because I built a little bit of a personal following. I've interacted with your posts.
I mean, I could tell from what you were posting, like you were serious about learning. Yeah. Like that's what like we're looking for with everything we do, right? Sure. And you're someone who's a go-getter, and obviously, now you're managing 30 million. I mean, it's fantastic. I want to jump backward for just a second to the SPACs and that edge. So basically, for people who are familiar, like the long and short of it is that SPACs are kind of a different way for a company to come to market without some of the regulation and tape with a normal IPO process. And basically, they, like you said, at net asset value, they're $10 a share. And so your edge was basically that the $10 a share was technically the floor. Yeah. So you were able to get asymmetric risk reward by finding names that are you understand.
I didn't understand,
but it was
risk reward at the time.
But now you do, and it's like all edges come back to asymmetric risk reward, which I think we'll talk about a ton.
All about like your potential reward is far larger than the risk that you're taking on.
Yeah. And going back a little bit, even before you started trading, you're obviously a competitive guy. Like,
Definitely.
I know you played soccer at a high level. That's how you met Connor as well.
We'll get into that.
Yeah, for sure. Yeah, let's jump back forward to where you were taking us. Yeah, what kind of happened next in your journey?
Right. So I had a personal brand, finished that internship with you. I read so many books, and we can talk about the books.
Yeah.
And so heading into senior year, I pretty much decided after I did that internship with you guys, I wanted to be in the markets. I wanted to manage money, and I'll go to dental school anymore.
Yeah.
And so I essentially DM'd Connor and I, without telling Don or anyone else. We just DM'd 30 portfolio managers. And eventually George, I can't pronounce last name, like TKA Tkachuk or Kachuk. Both of us talked to him. He didn't know we knew each other, and he referred us to Don because Don posted on X that they're looking to hire one person.
Yeah.
I followed Don. He followed me back. I DM'd him, literally just asking for a job, and he considered it. We got on a few phone calls, and then eventually he took me in for an internship just throughout the entire senior year. Ton didn't follow Connor back at the time, but he left voicemails into Revere's office, and Don's like, wow, these two kids are like persistent. They seem like they really want it. So we eventually both had an internship with Revere. Connor came a few months later because he had to finish his last semester playing Division I soccer. And then second semester, senior year, they gave us the offers. I dropped my acceptances. I was going to head to actually Columbia Dental Medicine here in New York City. And, surprisingly, my parents were pretty, I'll just say, chill about it. They just wanted me to complete the path that you want to put myself on, and just get that acceptance. And then they said you could make whatever decision you want.
That's awesome. And, thinking more about your trading, what kind of style did you develop after that 50% drawdown? Obviously, you did a bunch of studying of all these fantastic books that we'll get into, but what was kind of your trading journey like? How are you performing? Obviously, we had a bear market in 2022, all of that. There's a lot of learning experiences, I'm sure. So yeah, tell me about kind of your trading progression, the style you kind of built for yourself from that 50% drawdown.
Okay. When I started, it was how to make money in stocks. So I read all the right books, and it was a swing. I describe my style now as thematic and catalyst momentum trading, or just essentially trend following. And yours is similar as well.
Yeah.
So that's like that's the big bucket is trend following. And then I would say a sub bucket is more like growth oriented, like rooted on canceling principles.
Right.
But Connor and Don have taken a step further. We don't fully require the earnings and sales sometimes, especially with like a lot of hot themes in the markets now, like crypto. There's no earnings, and we're still willing to play those. So after SPACs, it was just right into this current style, and it was just continuous improvement, iteration on the principles in all these books that I read and courses I took, like Stan Weinstein's course as well.
Were there any key trades after that 50% drawdown that like were a turning point in like how you thought about your style? Like it could have been a great winner, or it could have been, we learned so much from our losses, and you're going to share, some mistakes today and lessons from that. But yeah, were there any trades that really made you think? And like both winners and losers can teach us so much. But yeah, any trades that stand out?
Yeah, so there's like that hiatus period where I didn't trade that much because I was finishing my dental studies.
Mm-hmm.
So fast forward, let me just think about this for a moment. Well, a mistake was at the end of SPACs, Connor, myself, and another guy we met at boarding school playing soccer together. We got caught in the super illiquid like warrants of SPAC. It's like so far off, like into the risk like curve.
Right.
We were all caught in illiquid SPACs, and we essentially had to unwind it over like weeks, like stepping over each other. So I mean, obviously, big lesson there is trade liquid stocks, assets relative to your account.
Yeah.
And whatever size you had. So I mean, that was a big lesson to start, trade liquid stuff.
Yeah.
In terms of a winner, like the whole period between my dental admissions test into your internship, that was like I don't remember that period too well. It's more my memory for trading starts more after I joined Revere and that internship with you. That's really like where everything started coming together.
Yeah.
Big trades. Let me think about that for a moment. Really, I'd say the biggest turning point is probably NVIDIA of early 2024. So it is a pretty was like a jump in 1 year.
Mm.
Like that whole year was kind of just developing the process under Don, just really reinforcing the principles and actually like putting the theory into practice. And I'd say NVIDIA 2024, that 6-month, that 6-month breakout that Christian Flanders, who's been on your podcast,
Killed it.
Ariel, I'm sure you probably caught it too. And that, I think that was a turning point, like where things started to come together. SMCI as well on the episodic pivot around that NVIDIA time too. So those are the two big ones.
Yeah, I mean that base is just it. Everybody should study that base. You know,
It's
and like
a perfect.
it had the
chart.
it had the theme. It had already doubled or more off the lows. It was starting a new stage 2 uptrend.
Yep.
It had all the characteristics coming together. Gap up,
undercut reclaim too.
undercut reclaim.
And at the time, I think that was 400 pre-split, 150 day too. And at first, you're saying, like it seems like the limit is rolling over. But as you guys term, like an expectation breaker, quickly reclaimed, and then a shakeout in a base is a great characteristic to have. You get rid of the weak hands, institutions accumulate those weak shares, and then they're still bullish NVIDIA based off forward earnings and sales.
Yep.
So that was probably a turning point.
Yeah, and
like
it's done incredibly.
Nailing that into that like swing move for a couple months or at least a few weeks was definitely a turning point. It's like now you have confidence that you can nail one of like the TMLs of the market or true market leaders of the market.
Yeah. Tell me more about your time at Revere. You know, key lessons that Don Vandenvoorde, taught you guys when you first joined. How you guys approach risk, because I think that's what sets you apart. Don, was a part of our conference that we just did a great presentation on that. We'll probably link that down below. But yeah, tell me about that experience and like, his mentorship and how that's had an impact on you.
So he's one of the most disciplined, systematic, data-oriented like people I've ever met. He has these complicated spreadsheets. Like he's an Excel wizard, tracking every data possible. And I think because of that, clients love it. We have that daily video. He has these spreadsheets. Like any statistic a client would want to ask for, Don could provide. And that, like for people, most of our clients are heading into retirement or in retirement. It gives them this peace of mind that they have this guy who literally tracks every data point possible. The biggest principle Don has instilled on us is it's not how he says this all the time. And after every one of our like weekly podcasts, it's not how much you make, but how much you keep that matters. And, we have all these traders, including myself. You do well, and then you give it all back.
Right.
And especially pure retirement, you can't do that with your nest eggs.
Right. So
that I would say that's number one principle. And you read all these books, it's all about risk management, stop losses, sizing your position properly so you don't take excessive risk on a total portfolio. I would say those are the main principles Don instilled in us.
Yeah,
and
so important.
He has a facetious one. I can't say the word like on podcast, but it's don't F it up. That's his number one rule to us. Like literally when we first joined, he says the biggest rule in portfolio management is don't F it up.
And what does that mean? What does that mean exactly? Like don't lose too much, or
like kind of like Buffett's like don't lose money. Like first rule is don't lose money. Second one's don't forget rule number one. So it's always risk first. Get risk conscious, smoothing the equity curve. Don't take excessive risk.
What does risk mean to you in the markets? Like if you had to kind of define it, or think about the key ways that you manage risk. What does that actually mean for you?
So there's like many definitions of risk that I've learned over time, and we can get into the different definitions. Essentially, to me, risk is the potential to lose money, or just a situation where you'll lose money.
Yeah.
But I have this other definition of risk I learned from either Morgan Housel or Howard Marks, and they essentially said risk is what can happen but didn't happen in reality. And I really like that because humans love hindsight 2020. We see something that happens and we don't even think about what could have happened.
Right.
And so I think risk is that, and also the potential of permanent loss.
Yep. Excellent. And
some would define risk as volatility, which I could see as well. But to me, risk is losing money.
Yeah, I think we share that perspective. I want to dive into the key books that made a difference to you, and any other kind of key influences you've had. So yeah, I know.
Can I interrupt real quick?
Yeah, please.
And another philosophical view on risk is also opportunity, because you can't there's nothing in the world where you can have upside without taking risk.
Right.
Even starting a business, being an entrepreneur, taking risk in the markets, it all comes with risk. Asking a girl out, even on a life basis, there's risk to that. So like cold DMing you, the risk is you ignoring me, ghosting me, and I just feel embarrassed. I feel crap. So there's all risk. So risk and reward to me are like brothers or sisters.
Yeah. And we as traders, our job is, like you said, first rule, don't lose money.
Yeah.
Our job is to manage that risk and manage that risk in a way that we still have that upside. But if we're wrong on any idea, it's not about being right. It's about what if we're wrong and, planning for that.
And then that's why you study patterns in the markets, because you could place yourself in a situation with asymmetric leverage and where you get out. And if it does work, you don't know if it's going to work. We don't know what the future holds. But if it does work, that potential upside, because we study the biggest winners in the past, the patterns, we could potentially in our heads expect or not expect what could potentially happen.
Perfect.
And you could structure trades in that way to have that asymmetric.
Hey everyone, just want to hop in real quick for a word from our sponsor, Public.com. Support for the show comes from Public.com, the investing platform for those who take it seriously. On Public, you can build a multi-asset portfolio of stocks, bonds, options, crypto, and now generated assets, which allow you to turn any idea into an investable index with AI. It all starts with your prompt, from renewable energy companies with high free cash flow to semiconductor suppliers growing revenue over 20% year over year. You can literally type any prompt and put the AI to work. It screens thousands of stocks, builds a one-of-a-kind index, and then lets you backtest it against the S&P 500. Then you can invest in a few clicks. Generated assets are like ETFs with infinite possibilities, completely customizable and based on your thesis, not someone else's. To learn more, go to public.com/TraderLion and earn an uncapped 1% bonus when you transfer over your portfolio. That's public.com/TraderLion. This was paid for by Public Investing. For full disclosure, check out the description below. And we've got a link right down there for you for your convenience if you want to learn more about public.com. Thanks for your support, and we'll be right back. Yeah, and I want to get into the characteristics that you look for a high potential trade. But yeah, first I do want to go to those books, because I think you brought a lot of great ones that made a big impact on me as well. So yeah, walk us through kind of the key ones. Yeah,
I'm going to start off with non-trading books.
Sure.
And then I'll go through trading books, and then at the very end I have like it's like a different subject, but it applies to trading too, like some of the laws. The first one is, probably point to this camera, is Atomic Habits. I had the workbook with me here, and I highly recommend it. I first would recommend reading the actual theory, which is Atomic Habits by James Clear. I think it's a top 100 selling book of all time. 25 million copies sold. I'm sure you've read it too. And anytime anyone asks me like what book to recommend, I always say Atomic Habits, and they haven't read it, because our entire life is a product of our habits. Your eating habits, your exercise habits determine how fit you are, how long you live. Your risk management habits determine if you survive in the markets or not. Even how we think, how we communicate with people are all habits that sometimes we're not even aware of. So I think reading the book and doing the workbook can really increase self-awareness of what you do day to day, and you can be more intentional of building your habits. So some of the principles in here, like implementation intentions, habit stacking, we can go through like my whole daily routine, trading routine eventually, and some mental models in here that I repeat to myself every day is get 1% better, or even 0.1% better, because the math is if you get 1% better for 365 days, you're 37 times better. But there's a caveat to that, and the vicious part of that is if you get 1% worse every day, you almost become zero in a year. So you want to make sure you never drop a zero, as James Clear says, and continue to allow positive compounding in your favor, in money, in your eating habits, exercise habits, and like social habits. So everything compounds if you intentionally build good habits. So I really think this is important.
One of my favorite, I'm going to paraphrase it.
Yeah.
Probably butcher the quote, but it's like, we don't aspire to our goals.
You do not rise to the level of your goals, you fall to the level of your system.
There you go.
Another one is each action is a vote for the person you want to become. I mean, I could talk about this book forever because I've listened to so much of his stuff. Just stop me if I talk too much and go off on too much of a tangent on this book.
I think we'll leave it there.
Yeah.
Again, also recommend it.
Yeah. It's amazing.
Yeah.
Like there's a 4 behavior, like the laws of behavior change, make it obvious, make it attractive, make it easy, make it satisfying. And if you follow those laws, you can build great habits. So I'll leave that there. The second one, I've read a page a day in for like 4 years in a row, and there's like a compliment journal that comes with it. Have you heard of The Daily Stoic by Ryan Holiday? And I loved it so much after 2 years that I got the leather bound edition. It was probably 5 times the price. Like the regular one's $20, this one's about $100, but I wanted this to last like a long, long time because I don't see myself not reading this. So it's just a page a day. You know, I wonder what today is. It's for the hot-headed man. It's about like managing your emotions. So there's a piece of wisdom every day in there from Marcus Aurelius, Epictetus, Seneca, and I think being stoic. So some people see stoicism in a bad light. They think you're unemotional, but more stoicism to me is being able to actually process your emotions and regulate it so it doesn't affect you in your actions. You're being impulsive. And I'd summarize stoicism in like one sentence: is focus on what you can control and forget what you can't control. And that events and circumstances that happen in your life, you get to determine the story and meaning of it. And I know Mark Minervini, which we'll talk about in the future, believes in that principle as well. So that's the Daily Stoic. And then, of course, How to Make Money in Stocks by William O'Neill. Revere, the foundation of Revere is built off this book. Don's father-in-law was dying of cancer in the year 2000, and he had his money with Morgan Stanley, like a traditional asset manager, and they lost like 50% of his nest egg, who eventually passed on to, his heirs. So Don felt like there's definitely a better way. He's a curious guy, intellectually like curious, pursuing new knowledge, and he built his current system based off this book. Obviously, we built upon it, but this is the foundation of what Revere does. Yep. The next one, I'm actually rereading it right now, is How to Trade in Stocks by Jesse Livermore. And rereading this, I think it's now for the third time. I'm just realizing all the principles we talk about. This, like, it's pretty amazing. This guy lived 100 years ago and discovered all the principles we talk about now. Market leaders, the market, sister stocks, themes, industry groups, importance of like the situational awareness, like all those timeless principles. Best trades work right from the start. He talks about how important it is to keep your records, so also known as journaling. Keep your stats, journaling your emotions too, and we'll talk about that process too. And I mean, this is really a must-read book.
It's a quick read.
Yeah, it's a quick read. Yeah. And Jesse Livermore is one guy I found. Traders, investors, venture capitalists, private equity people, they all know who Jesse Livermore is. So amazing book there. Stan Weinstein's book. Stage analysis is a foundational part of my process. Like the first thing I look at a chart is based off stage analysis, whether it's in stage 1, stage 2 uptrend, stage 3 topping, or stage 4, looking at like the key moving averages on the weekly chart to instantly, like in less than a second, understand like if I even interested in looking at the chart further. So, this is a course. I've learned a lot from this because I read this book while doing the internship with you, and then actively applying it because you guys had me pick out charts from stage 1, stage 2, stage 3, full cycle. So I learned that really well, and it was one of the first concepts I learned. I'm glad I learned it.
And this was, so obviously, for those who don't know, like this was one of the, Stan Weinstein's stage analysis was literally the first training concept I learned from Dr. Wish's class, who got my start in college. And if you apply the principles of this book, like you're going to be positioned in the stocks that are making the biggest moves and avoid the largest drawdown, which is the whole name of the game. Asymmetric risk reward, like we've talked about.
And it's not just applicable to stocks. It happens in crypto, commodities, fixed income, currencies, all markets. You can see the cycle happen over again. So, it's just rooted on principles of supply and demand and human psychology, as Stan says, and he believes that tape tells all. Yeah. Yep. This one, we were talking about it last night at the New York City meetup. You're rereading it right now. It's a classic, and it's just a great story. Yeah, about this dancer who got in the markets, discovered all these timeless principles, and turned very little money into $2 million at the time, which is, I don't know the inflation adjusted number, but huge amount of money, especially for a dancer who put in buy stops and sell stops, was traveling around the world, not even look at the quotes constantly. There's a lesson in that. Leads to less impulsivity. Ed Sekoda says, like, if you sit in front of the quote monitor, it just becomes a slot machine. Like, we'll just keep clicking the buttons. And that's how you lose money. You overtrade, you force trades. You sell stocks you shouldn't sell because there's some sort of intraday wiggle. So great book as well.
Yeah.
I think
Yeah, go ahead.
beginners should, like people who starting the markets should maybe even start with this one. It's just an easy read. It's entertaining, and he shares a lot of times principles through great storytelling.
Yeah, it's such a quick read. Like literally in one day you can read that one, and it's probably like I would echo that. Like first, as a first book, I think it's fantastic because yes, he develops a system which echoes Livermore, echoes all the market wizards, but also you see him in real time make all the mistakes that you're going to make, even before you make them, and then figure things out as you go. And he literally walks you through his trades, the good, the bad, the ugly, the success, the drawdowns, the bear markets, and he's developing his system in the book in real time. And like I said, you can read it in a day. So
Exactly.
I love this book so much. Yeah.
And then the whole Jack Schwager Market Wizard series, I think it's a must read. But honestly, I wouldn't start with the Market Wizard series because some of the wisdom that they share, you'd understand much better after a few years in the market, in my opinion. Like I'm probably going to reread the whole series now, and I'm almost finishing my 6th year and rereading Livermore. There's these principles and sayings that I get a lot more now because I've been through the cycles. I've been through the psychology, understand like all the psychology of the cycles and the quotes much better because I've had more experience in the markets. And in a way, I think most people that go through a big drawdown and lose money will learn these principles much better. There are like special traders like Ariel who literally just starts and then rocket ships off and never really goes through any huge big drawdown, which that's the exception. As you know, like all the traders you've interviewed, they've all gone through some sort of big drawdown, most of them at least. So Market Wizard series, this is the original one. William O'Neill's in it, Paul Tudor Jones, Ed Dakota, Richard Dennis, Michael Marcus, all the legends. So definitely a great read.
And all of these, like you said, the more experience you have trading, like the more you're going to get out of it. And, rereading the best books, you get more out of it each time, which every book you've mentioned, like I come back to Darvis and it's like, I'm in the moment. I get pumped up. I'm like, oh man, he's going to make his fortune. And then you experience the losses with him and then how he comes back. And then you read the little nuances that he talks about, price and volume action. His box theory is the same as bases, consolidations. Like it all aligns, it all comes together, and you notice more each time you read it.
In a movie on that Darvis movie.
I would love it. I would love to do that.
Someone made
watch that for sure.
And back to your point of rereading the books, I forgot what writer, poet, or philosopher said it, but like essentially, like we're always changing, like mentally, physically. And so when you come back to the book, you're not the same trader as you were 2 years ago. I think the quote was something like, a man can step in a river twice, but the river's not the same and you're not the same. So it kind of applies to rereading books. And oftentimes rereading the best books is more important than trying to read so many. Like reread like the best 100 books is probably more effective than reading like 1,000 or 5,000 books. I don't even know who can read that much.
Or even just 10. I think
it uses the 10 best books. Yeah. So, I didn't want to bring everything. I could only fit so much, but Mark Minervini's books are amazing. He's in the Market Wizards as well, the Stock Market Wizard series. I love Stanley Druckenmiller, so I've watched so many of his interviews. He has a 2009 one, and I've posted on Twitter a whole playlist I've found on YouTube. Yeah. So if people want to go there, they can search Druckenmiller on my page, and there's this playlist I made on YouTube. He's on 30% a year for 30 years, and I think I resonate with him because I am managing other people's money. So I love these individual traders too, but I kind of go towards some portfolio managers or hedge fund managers for inspiration as well. Like Paul Tudor Jones, Steve Cohen, they're all some of the greats in the business. And what was I going to say? Last book, this might be a surprise, but 48 Laws of Power. Some people say this book is pretty dark, and there are principles that are pretty dark, but I would take the good parts of this book. And some of it applies directly to trading. Like when I read this book, it was pretty incredible. For example, like Law 35 is master the art of timing. I mean, we're going to talk about how important timing is, because if you're early to a stock or if you're late, it doesn't matter. You're going to miss the move. So, I mean, you could be right on the overall direction of the stock. If you time it wrong, you get stopped out. You miss the move anyway. So master the art of timing. 29 is plan all the way till the end. So before getting in the trade, you already want to know where your stop is. You want to know your position size, how much you're risking, potential. I don't like profit targets, but sometimes, you can use like a measure move to give you a sense of how much a stock can move. You can have like ATR extensions as well. So some sort of general target, or at least, okay, I'm going to trail this moving average or a combination of moving average for this stock, or William O'Neill's climax rules. Just being conscious of when those characteristics start showing up in the chart.
Yep.
You're looking to sell some in the strength. So, plan all the way till the end, master the art of timing. There's some other ones. The last one he says is arguably the most important, is assume formlessness. So in the markets, being flexible, being adaptable, the markets are always changing. So being a little formless, but also having some structure is critical. And I think the Bruce Lee quote is like, be like water. So yeah, and I just think that it's incredible. There's other principles in here, but that applies to the markets. And I really like reading books and subjects where I can cross principles into the markets as well. I think Morgan Housel said it. Some of the best books he's read about the markets is on history or psychology or like human nature. So I'm a big advocate for reading non-trading books and look for connections to the markets too.
Yeah, because the markets are human nature at the end of the day. So there's lessons all over. Yeah, great, Ted.
And then
go ahead.
Obviously as well, right here.
Oh, thank you.
I didn't bring it because
it didn't exist when I first started.
Yep.
But I read it recently, and I think it's a great start for traders as well to really wrap up all the concepts, because these books don't get into how to screen, how to even set up a screen. And honestly, like, I wish I had those lessons before, because I kind of had to figure out, okay, what screens do I want, and how to piece it together. So yeah, it's a very comprehensive book, tying all those principles together.
Yeah, thank you. Like, that's what we try to do, is like how to build a system. Like, it takes into account all the principles that are in those, how to apply it. That's kind of what we're trying to do with this book.
And then last mention, Christian Kolamagi, all of his streams, YouTube videos, just there's secondary YouTube channels that have clipped his streams. I mean, it's just amazing, and he's such a funny guy too. Yeah.
Perfect.
So those are a lot of big influences.
Yeah, like you said, I don't know about 100 books, but just stick with those.
Yeah.
Read those a few times.
And then trade, and then come back to those.
Hey, not 100 trade.
Yeah,
like
I'll
I got you. Yeah.
I gotcha. But yeah, each time you come back to those, there's gonna be new lessons.
It's amazing,
which is awesome.
What about you? What book? I mean, besides these, you have any other books that?
I'd say like Mark Minervini's books are fantastic, especially when it comes to risk management. I think he really showed the application of that. In our book as well, we talk about defining your open risk, which I know Don is huge on, and knowing what that drawdown will be if you get stopped out. But yeah, Mark's books are fantastic. Yeah, I think you stole all the good ones that I love. But Gil Morales, O'Neill Disciples, those are fantastic too, especially regarding kind of newer edges in the market. You talked about themes, the gap ups.
Yeah.
And then I get a lot out of, in addition to Kolamagi streams, like there's a lot of great traders who I've learned from, online, like Pradeep Bande.
Your podcast too.
Yeah. Well, thank you.
Yeah.
Every
for you.
every single podcast, I take a few things. At the meetup yesterday, a lot of people were like, with all these podcasts, how do you focus on your trading and focus on your style?
Yeah.
Well, I'm confident in my style, but I can always take bits and pieces from everybody else and add a layer here, add a nuance here, and see if it works. If it doesn't, I'll throw it out. But every single podcast, there's something that you might explain that I just didn't notice, this subtle gap. All right, I'll start to look for that, and add that to my arsenal of tools and build my vocabulary in terms of how I describe trades and analyze charts. So, I think podcasts are a great way, especially longer form, when traders are walking through their trades, which we're going to go through. Yeah, go ahead.
To wrap up the book section, I would say people getting the markets really have to love it. There must be a natural inclination. And so the last book I wanted to mention is Mastery by Robert Greene. I've listened to a bunch of his. I haven't fully read it, but I'm really familiar with a lot of concepts because I've listened to so many podcasts of his.
Yep.
And he says that your life task is not discovered in adulthood. It's reflecting back on your childhood and what you're obsessed with, what you're naturally drawn towards. And if you don't know, ask your parents, ask your friends, ask someone that, has seen you grow up. And for me, like you said, soccer for both of us was a big one. It's highly competitive. There's strategic thinking involved. There's player versus player. And I also really enjoyed video games too. And the intersection of sports, video games applies directly to the markets. And there's so many great sports analogies that I repeat to myself every single day. We can get in those
Yeah,
as well.
I think both sports and video games like teaches you how to lose and how to keep trying and like keep trying to improve, beat the level, learn a new step over, crossover skill, all that stuff.
I think for both you and I, player versus player, that PvP, it's like that acronym is what we're drawn towards. And inherently part of that is a lot of human nature, game theory, psychology, competition, like a scoreboard. For example, like social media, your podcast, you're kind of competing for people's attention. In the markets, we're competing to extract profits. In entrepreneurship with TraderLion, Deep View, you're competing for the market for people's SaaS use for Deep View. There's a bunch of education platforms out there too. So it's that player versus player mentality that I think we both love and all traders love.
Yeah, and in all these endeavors, sports, business, trading, yes, it's like against other people, but it's also against yourself
too. Right.
and like learning new skills and always learning. That's the biggest thing. Yeah. Yeah, excellent, Ted. I want to dive into your style a little bit more now. And to start with, you talked about thematic, swing trader. That's kind of your overall style. If you had to build a kind of a recipe for an ideal trade, what would be both the technical and maybe fundamental characteristics you look for? And maybe start with the fundamental, and then let's dive into the technicals as well.
So Connor and I have taken CanSlim and modified it. We call it our magic elixir or super stock criteria. And I'll just go through one by one. First one is learn the lesson. It's got to be liquid. Don't want to get trapped, especially client money. If we don't want to get trapped in an illiquid stock and we're running over like our own money, our own footsteps, trying to exit the stock. So liquid, high ATR, ADR, or at least high enough. We personally, being Turbotection, the more aggressive portfolio, and being younger in our careers, we want to be a little more aggressive. That's our purpose in under the hood of Revere as well. That's our mandate. And we don't want to be in a stock that's trading 1% a day. It might take 10 weeks for 15% gain. We'd like at least 3%, 4 or 5%. We can get those few weeks, 2 months, 50, 100, 150% gainers. At least a potential for that opportunity. So liquid and high ADR. The next one would be linear. Mark Minervini has this analogy. If you're trading a bucking bronco, it doesn't matter if it goes up 100,000%, but if you get bucked out of it, it doesn't matter. You don't capture any of it. So a stock that trades linear, respects key moving averages, the 10, 20, or 8, 21, depending on what you use, respects weekly moving averages on a longer term time frame, like the 10-week or the 20-week. We've seen the markets become a little more volatile. So the model book stocks you study in William O'Neill's books, they just literally trend the 10-week up. I wish all stocks did that now. Some still do, but those are the exceptions. Many mean revert back to the 20, even 30-week moving average now. So to really catch the full cycle is pretty difficult. So moves come faster too, like Stan Weinstein talks about. So we're really trying to capture that 2-3 month move. So even in a way, maybe I've transitioned more as a position trader, less of a swing trader.
Makes sense. I mean, you guys are managing 30 million, so you do have to take a little bit of a longer view. Yeah.
So high ADR, liquid, linear.
What's liquid? Just to define it, like,
because for Dawn, it's different than Turbo. For Dawn, it's like 300 million on average. Yeah, and maybe even 400. Well, yeah, about 300. How he's kind of scaling it is like AUM. Once Drawdown hits 400, he's going to scale that up to 400. But there's so many liquid stocks now trading billions of dollars that fit this criteria. It's pretty incredible, and part of that's probably government spending, the Fed printing trillions of dollars, and all this money is injected into the economy. So it's a great time to be a trader right now. You have these stocks moving 10% a day, trading billions of dollars. So that is really no problem. There's so much opportunity in the markets nowadays, throughout entire history. But we were talking about this yesterday. Even Darvis, like in his book with Livermore, like they're talking about trades and trade 300,000 shares. It was pretty fast. And now it's like millions and millions, billions of shares traded. So Just a step back review, liquid, high ADR, linear, but also previous history of making big linear moves. As long as it's not an IPO, or else you just have to judge the price and volume based off what exists now in the theme. And then the next part is hot theme, narrative, story. And then this is where we differ from CanSlim. CanSlim requires the 25% earnings and sales, annual consistent earnings growth.
Yeah.
For us, it's hot theme, narrative, story, and or a catalyst. It could be earnings surprise. It could be a partnership. It could be a government regulatory change, executive order, industry regulatory change for like rare metals. It could be new CEO, new product launch, like ChatGPT ignited everything. Not for a specific company, but for a whole industry. New service. And then it's and or fundamental, so acceleration of earnings and sales. There's some sort of moat, pricing power, network effects like Instagram, Google, Meta. Instagram and Meta are the same thing. X, like earnings surprises, a trend of revenue growth, return on equity, all those metrics. But we don't require those three main buckets. Even if it just has one, we're willing to trade it, because you have a hot story in quantum or hot story narrative in crypto. There's crypto, some people argue there's fundamentals. From a traditional finance theoretical standpoint, there are no fundamentals. You can say maybe it's a commodity, maybe it's not, it's a security. Who knows? Like, the classification is still very blurry right now, but there's no earnings and sales, and we're still willing to trade those moves as well, because there's fantastic opportunity in those momentum trends. And then finally, probably the most important of all is market context with the price and volume characteristics of the market and the stock and the theme or the group. So, relative strength. I use market surge before deep view. So I use the AS ratings. I like absolute strength because it's like the absolute compared to all the stocks, not relative to S&P. I just want the strongest stocks in the market. Absolute strength of 1 month, 3 months, 6 months, 12 months. I have those measures.
Like 95 plus.
And that's how I scan as well. Just 90 plus, 95 plus. I want to look at the best stocks, the highest momentum stocks. And from there, that pre-qualifies for me to look for the rest of the Magic Elixir criteria. And I just like that word. It's like, kind of mysterious, but it's what everyone does.
Yeah, and that's what Darvis found. That's what Livermore found. Like, we're just evolving with the markets and how it changes. I think Darvis, one of my favorite excerpts from How I Made $2 Million is he talks about, I wanted to invest in the future, not with regards of like investing and holding a stock for 10 years, but he wanted to be investing in themes that were making a difference 10 years from now.
Right.
And back when he was trading, it was like rockets, because it was like the space age. And now
it's rockets.
We're back with rockets.
We're back with rockets.
So it's like every period in history has those innovative themes that create opportunities and create the companies that will double, triple, 10x, 100x.
Yeah, from your book, I could clearly remember a section. There's secular themes, like what we were talking about, technological revolutions that leads to these huge booms. And then there's more cyclical groups like housing, like financials, home builders, which really rise and fall, even retail in a way, which really rise and fall depending on the economic business cycle. Interest rates are rising or interest rates are falling, what the Fed's doing and what the governments are doing. So the secular moves are where the big sustainable moves come from, the consistent earnings growth. I mean, you can go all the way back to the railroads.
Yep. Exactly. Like I said, every period. All right. That's the Magic Elixir.
Yeah.
If two stocks have similar recipes, similar characteristics, what makes you focus on one versus the other? It's in the same group, maybe the bases are similar. What are kind of the nuances that you look for? Maybe it's more price action focused at that point.
More price action focused.
Yeah. So what differentiates? What would you focus on adding to, building a position in, versus maybe avoiding?
So for me, the main one, if all the Magic Elixir criteria is hit, it would be how linear it is. And I don't have a quantitative way of describing linearity. It's really like we can show the examples I show are going to be a perfect example of linearity. And when we get to GDX or Nugget, I'll show you the phase 2 years ago, how choppy it was. To me, it's one of the best examples I've come across recently of choppy into linear.
Mm-hmm.
So I would say how linear stock trades.
Cool. And
because you said if the constants are they're both in a hot theme, it does come down to price and volume, relative strength, how clean the base is, how linear it is. That's probably what we would differentiate between two stocks.
But sometimes you just never know.
Sometimes you take both.
Sometimes you take both.
And we've traded, but like for example, both SanDisk and MU.
Right.
Don has both. We only have SanDisk, we still have actually just a very small piece left. But we traded MU in the past few months too. So we're in and out of all the names. We typically do want to at least focus on the top two of the group.
Yep.
Because the more you get to the laggards, the moves become choppier, goes back to the linearity, and the moves are less in magnitude as well.
Yeah. And if there's kind of, obviously there's overarching themes, secular themes like AI is driving a lot of innovation right now. But, just recently we've seen AI drive energy plays. We've seen AI software plays.
Rare
earth. So like you'll try to find those top 1 or 2, 3 stocks within those smaller themes, within the larger themes. Is that kind of accurate to say?
Definitely. Yeah. I would say so. But Connor and I, even in the last year, have evolved as portfolio managers a lot. We are starting to realize we don't want to all be in just the AI bucket, because even if you're in, for example, during the DeepSeek gap down, everyone took a pretty big hit probably. We definitely did. There's no hiding that. We talk about it in our daily videos, so it's like full transparency to our clients. And at the time, you think you're in some rare earths, you're in ships, you're in data center names, you're in power generation. During those crises, that's the thing people don't get. You feel like you're diversified, but all correlations head to one. And that's another principle I learned from my bosses, them going through, especially Dan, since he's been in the asset management business a little bit longer than Don, like through 2008, through 2000. And we tell clients, especially when they come on board, they've experienced where correlations all go to one in a crisis, in a bear market. Being diversified really doesn't do anything. And that's why the best way, you have to have sell rules to manage the drawdowns, especially for people in retirement, for that smoother equity curve, for them to sleep at night. So that's really key. Even in bonds in 2022, it dropped more than stocks. So everything just correlated to one. Inflation picked up, and inflation's like the kryptonite of bonds, and bonds dropped like 30% while the S&P dropped max of 28. So this might be off a tangent. You can bring it back, but I just want to just add this anecdote. Dan always talks about that his 93-year-old mother is in Growtection with Don's money, with Dan's money, with all our clients' money. And people say, that seems risky. You're trading on these growth stocks. But when you look at the numbers, the risk-adjusted returns are superior to the S&P 500, superior to traditional asset managers. And Dan's 93-year-old mother, who's in her retirement home, all of her friends are 90% bonds, because finance just came out with this arbitrary way of saying your age minus 100 minus your age is the percentage invested in stocks. The rest are just in bonds. And they got creamed in 2022, and bonds still haven't really rallied back. So I guess that's the key lesson.
Yeah, no, like sell rules are key.
Yeah.
And we'll get into those with your trades itself. One last question before we go to those trades. Position sizing. So it might be different with your own personal account and Growtection.
About clients.
Yeah, that's fine. So yeah, break us down. Once you've got an opportunity that you want to go ahead, the technical setup is there. Everything looks good. How do you guys set position size? Do you build into that over time? Because obviously, at 30 million, you can't necessarily market order everything. So you might have to build in over a few days. Talk us through the process of defining that final position size you want as a percentage of your portfolio, and then how you arrive there typically.
So for clients, we typically won't risk more than 50 basis points. And more now we're risking way less, like 20, 25, maybe even 15. So we determine how much we want to risk on the portfolio based off how many points it checks on the Magic Elixir criteria, and then our own conviction in that opportunity. And so in Turbo, our max position size is 12.5%. And part of the makeup of Turbo and Grow is that Don has us have this index portion of the portfolio in 1x S&P, 2x S&P, 3x S&P that we dial up and down based off just our trend following models. In Growtection, the max sizing is 8%. It's typically for a little bit older people. A lot of people are in retirement Growtection. And with us, it's a lot more accredited investors. People understand trading. A lot of people who maybe have traded but didn't fully get it and want someone else to do it for them, or just high net worth individuals who want to take a little bit more aggressive piece of their portfolio with us. So we can be more aggressive. That is our mandate, to beat the S&P with lower drawdowns. Protection is S&P-like returns, sometimes a little bit better with far less drawdowns. So those are like the two kind of mandates of each portfolio. So back to Turbo. Besides the index, it's just based on our trend following rules. It's not like we're sizing it based off how much we're risking. And the rest of the portfolio, could be sector ETFs, leverage ETFs, and then primarily individual stocks. So like I said, we don't really want to risk more than 15 to 25 basis points on initial entry. And most of our positions right now, especially as Connor and I have developed, we like to take more positions now than super concentrated, because sometimes you just don't know what's going to work. And we like to diversify the portfolio between, at least some non-correlated bets, but sometimes the correlations are always changing. For example, precious metals for a decent period of time didn't have the same correlations with our AI stocks or some other opportunities like space. But on this momentum unwind, like everything fell, like gold, silver topped, potentially topped, SanDisk potentially topped too. So we kind of try to manage the correlations to try to have non-correlated bets so you don't just get smoked in one day, especially for clients. They're seeing their positions as well, since it's separately managed accounts. In a personal account, you might be able to withstand that depending on your psychological, emotional makeup. But one big thing I learned is in money management, it's not just managing money, it's also managing client emotions too. So we have to diversify, not risk too much of the portfolio. And like back to you said, when you see a hot theme, sometimes we like to create buckets now instead of trying to choose the leader. Like we identify the precious metals theme. I made a joke on Twitter. I just call it the stuff out of the ground theme. So we had some REMX ETF, which I'll talk about the chart, GLD, SLV, and just as that rare earth / precious metals theme, had a little bit of platinum as well. So we start making buckets and themes to have that extra, like to reduce some single stock risk. And at the same time, you don't exactly know what stock makes the biggest move. Like we talk about all the time on our calls. Sometimes you just don't know a stock you don't expect to make the big move. I didn't expect silver to do this, to be honest.
Yep.
And it just doesn't. So we just focus on position ourselves from like more of a top-down perspective, market theme group, and then find the leaders in there and just create those buckets.
So take us maybe through a hypothetical example. Like you said, you're looking to risk, and that's your entry and your stop loss defined based on the setup, a certain amount of your portfolio.
You want me to get on the charts right now, or more just theoretically?
Let's answer this question, then we'll jump to charts.
Okay.
But yeah, like, do you have a max position size? Because obviously
Max is 12.5.
12.5. Okay,
Yeah.
gotcha.
But those are saved for very, very great opportunities.
Yeah.
For example,
like the NVIDIA opportunities or MSTR. Late 2024, we had that. Bitcoin was a great 6-month breakout. Tesla had that. You can call it quasi-episodic pivot after the election. It's more of a story episodic pivot than really based off earnings or revenue growth. But in a way, it was like a government regulatory. It lowered some uncertainty around Tesla and Elon because he got into politics. So that was like a pretty great move as well. And those are the opportunities besides the 10, 12.5. So usually we don't get there.
Excellent, Ted. Let's jump right into some trades. You prepared a few ones you did well, a few you could have worked on a little bit more. But yeah, walk us through the full process, and starting with SNDK, obviously one of the best opportunities of 2026 so far. The memory names have been amazing. Yeah, walk us through from the very start, because this prior trend, I know you had a little bit of a trade there as well. But yeah, walk us through from the start, what drew you to this name, and walk us through the technicals as well.
Okay. Well, for each, I guess I'll go through the framework of Magic Elixir, so we get some repetition there. So starting off with SNDK, this is coming out of a spin-off base. Deep View, the charts it has some previous price action, but so this day, I believe it was MU earnings, and on the conference call, they talked about a huge supply and demand imbalance. And when you have supply and demand imbalances, that can lead to some massive moves because there's just so much demand for a little bit of supply. It's like a stock. When you have little supply, like Minervini talks about, that's literally what the volatility contraction pattern is, where when that final tightness, that final contraction has low volume, that's supply not coming to market. And then when there's a little bit of demand, price explodes. And it's similar to memory. We've seen SanDisk, MU, SK Hynix, which is a South Korean name, all like raise their prices because there's so much demand and they can just squeeze more and more out of what they have. So SanDisk gapped up on this incredible, just 137% move instantly. When I see that, I'm stocking for a high type flag. And so in Turbotecction, and all these are trades, the trades I'm going to share were all trades in Turbo. Some are recently closed, some we're still in. So this will give a perspective for the listeners on how we kind of trade and what we look for. So in this area right here, we made a 137% move. I'm going to just draw a little bit of a trend line. And then we...
Little shelf there.
Yeah, a little shelf here. Just such a powerful move, backed by the theme, memory, other names of the group are working, MU, WDX, STX. And so when a group move is happening, you better be paying attention, especially when you know the fundamental and story. There's fundamentals, there's a catalyst, there's a theme.
Look at the volume coming in.
I know. How linear it is too, Richard. Like, honestly, if you were to define linearity more quantitatively, it's probably how much it's spent, like how many days in a row where it doesn't break the previous day's low. That could be a way, or how much it respects the 5-day.
We're gonna have a score. We're gonna have a score in DFU where, like, over a period, percentage of time it's over a moving average, and we'll turn that into a score. And the priority is low. I like that too. So we'll maybe have different components. But yeah, I think
has a linearity score as well. I forgot exactly the criteria, but it's a combination of, you know, how much time it trends above a key moving average and like that versus the previous low of the day versus previous low of the day and previous high of the day.
Yep.
And so you can see SanDisk right here. It gapped up, never broke this previous low of the day, made a new high, never broke this, made a new high, made a new high, made a new high, made a new high, made a new high. So I'm seeing this. It's so linear, such a powerful move. Fundamentals, macro, theme, everything is doing well. And during the September time, the markets were doing well too. You had quantum doing well there, nuclear, space. And so I'm just watching it. Back here, too short of flag for me.
Mm-hmm.
Only 3-day pullback into the 10 EMA. The shop uses the 8 EMA, 21 EMA. I like more of the 10 simple or EMA and then the 20 SMA. Hopefully Don doesn't get too mad. But I still have like a Revere set as well. And honestly, I found that because so many people are looking at the 8 and 21 and the 10 and 20, I'll flip back and forth just to get a greater perspective. Yeah. So now this consolidates for 1, 2, 3, 4, 5, 6, 7. And for high type flags, for me, like 6-7 days is absolute just minimum. I wouldn't want to trade something consolidating for 3-4 days, especially for clients and as a portfolio manager where you don't want to just be in and out, in and out, in and out all the time. So I'm seeing this, and Connor and I both have it on the radar. We undercut, reclaim the 10 EMA. We have this expectation breaker where it seems like it closed below the 10 EMA and it's going to head downward, and then it gaps up again, closes at the highs of the range, gaps down, oops reversal, which is this one little mark I have. It's a deep view technical indicator, which I have. And then these downside arrows, it's just ridiculous how strong the stock was. This is the 10 ATR extension above the 50. And literally every single day people see this and they're like, it's extended, but oftentimes the best leaders are always extended and they just keep on going higher. So you buy it out of here, just stop in this 10 EMA area, and we just ride it all the way up. There's some sells in the strength. I forget the exact dates for this first trade. Sorry about that. And then we close it on this day right here where you have a downside.
Where did you close it out? Do you remember as it broke that key low or a moving average? Or where did you sell it?
The final piece was closed on the close of the day. We trimmed like pieces in this area as well as this area, but I didn't mark up this first one. So we'll get to this the recent trade. We still hold it a little piece left. So we have this big day. Now I've seen you tweet before. When you have a huge shot across the bow like this, you usually need like a couple months or at least a few weeks.
A consolidation. I think I call it like a base starter bar, or I don't know what I call it.
Starter bar. It's something like that. Yeah. But you see this, you don't want to expect it to be buying it within a few days. Yeah. At least from my experience.
You also had that negative expectation breaker right off the top there, where
right here.
Yeah, that bar. So it's like a little warning shot, lower high gets set, and then we reconfirm lower through that little shelf that was forming. Yeah.
And this was one of like the last generals standing at the time.
Mhm.
This was November period. Markets are getting choppy. There's like a lot of geopolitical tensions too, government shutdown. So this was like kind of a signal, canary in the coal mine, especially when SanDisk, the strongest stock, is breaking down like this.
Talk me through, zoom into the entry. Just one last second. I got a question. Yeah, zoom in. Yeah, just zoom in quite a bit. I know you're on your laptop here.
Yeah, it's
Yeah. So, you bought the gap up basically. Is that correct? Like, yeah.
It was literally just over the 135, 136-ish level.
Yeah. I know you didn't prepare this trade, but where was your stop? Was it low of the day on that day? A little bit below that percentage wise?
It was rather the EMA.
The 10 EMA.
Yeah.
Gotcha. Technological stop. Perfect. Yeah, great high flag trade.
But once we have this igniting bar, we raise it to low of the day.
Low of the day.
Just, we try not to have a lot of day trades, even on a risk management standpoint, which is why sizing a little bit smaller is key.
Yeah.
But obviously, it's always risk first. If it completely just reverses, we're getting out. Like, we'll use a day trade for that. But we don't want to day trade too much.
Yeah.
That's kind of just from a portfolio management standpoint.
Cool. Zoom us towards the current trade now. It's set up a new base. Walk us through that full base.
Yeah, let's do that. So
Yeah.
I'm seeing this. It's still going to be on my radar because, I mean,
Let's move.
look how linear it is. 400% above the 10 EMA with maybe one close below. That's just incredible linearity. It's trading 14 million shares a day at 200 something and change. So liquid, it has all the magic elixir as we talked about, Richard. And I see this. I'm going to keep it on the radar, but it's not going to be on focus. And so let's just go bar by bar. You know, we have some sort of demand here at the 180 level, but I'm still not interested. It's coming back in. The 10 EMA is crossing below the 20. When that happens, I'm definitely not interested in going long. That's really...
It needs time. It needs to work out that bar.
Especially with the situational awareness of the markets. Breadth was deteriorating. Yep. Government shutdown. There's a lot of uncertainty, especially without CPI data, labor market data, heading into December FOMC. There's a lot of uncertainty everywhere. And the leaders were breaking down, which is the most important thing for us.
Yeah.
The health and breadth of the leaders. And then at Revere, we have the trend gauge on our videos, and clients really like it. We distinguish the short-term trend, usually based off the 21 EMA, the medium-term trend based off the 50-day, and then long-term trend based off the 200. So we have those three, and then our subjective analysis. Well, part objective, part subjective of the health and breadth of the leaders, which Don calls the 21 over 21 list. And in your first podcast with him, he talked about that. And then he recently created the Turbo 12 list as well. So from those two lists.
He likes that alliteration.
Yeah, he loves the alliterations. So you can see 10 below the 20 from a swing trading, position trading standpoint, at least the entry standpoint, it's off my radar. So let's just go bar by bar. Now this is around the 50-day. Usually best leaders test the 50 days sometime in a cycle, and oftentimes it's a great place to start a position. But Ross, I've seen, says it's hard to start a position the 50-day, especially when the markets are not doing well. So we didn't start a position near the 50-day, although that, with hindsight, with such a great leader in the future, it'd probably be wise to even take maybe 1% size at the 50-day just to get your feet in there.
Keep watching it.
For me, psychologically, once I have that first position, it's easier to add into a winner. And actually, just on that topic, I never will add into a loser like that martingale. Like, I'm never adding to losers, always adding to a winner. So that's a key principle as well. So now I'm seeing this reclaim the 10 EMA, but I like the 20 SMA. For me, I found the EMA, the 20 EMA or 21 EMA gets me into more false starts. And for me this year, one of the big intentions is maximize reward to risk, but also maximize reward to aggravation or frustration. We're in this game for the long run. I don't want to lose my mind, being in and out, being frustrated all the time. So for me, I found the 20 SMA to keep me more out of frustration names. For example, we can do a little analysis here. This is the 10 EMA and 20. We reclaim the 10 here. I'll put on the 821 real quick. You see how it reclaimed the 8 and 21.
Yep.
The difference in that. And even here, the 8 was above the 21. You might have tried it here if you were less disciplined in your entries, but I'll put on my 10 and 20. It doesn't look as attractive. And look, right here, you reject the 20 as well as that previous high, and you still live below the 10 and 20. And now I'm seeing we reclaim the 10 and 20, but the slope of the 20 is still declining, so I'm still not interested. I'm not buying there. And sure enough, a kicker candle to the downside, back to the 10 and back below the 10 and 20, and now back to the 50. In hindsight, this would have been the place to start it, but we were noting it as a team. It's finding support, building higher lows, higher low here, higher low there. a upside reversal, not even on volume, but you can see the volume is completely dried up. So sellers, to me, this means sellers are kind of abated or just less sellers now. That's a great characteristic in a basing period where volume dries up, especially at the bottom of the base. And eventually we see this, we reclaim the 10 and 20, the slopes of the 10 and 20 are up. And for me, I found the least amount of frustration when I'm trading above all key moving averages and all the slopes are rising. So I just want to be even more disciplined about that. As we know, you're trading, my trading, most of your winners or most of your gains come from that 5 to 15 to 20 winners in a year. So I just want to be so disciplined, wait for those fat pitches. And I found all my best winners have been above all key moving averages.
On the buy.
Yeah, on the buy. So I'm seeing this now, reclaiming the key moving averages. But I identified this one level here and rejected that. Then it kind of gaps above, fades, but finds support the 10 EMA. And this is the day we take a 2.5% position. And since it's high ATR and the markets are quite uncertain around Christmas time, the holiday trading could be kind of choppy. There might be some tax loss harvesting. There's like a lot of weird dynamics like that last week of the year and that early first week. So I see this, and this is starting to look quite symmetrical. It's above a rising 10, rising 20, rising 50, 100, 150, 200. I see this inside day volatility contraction, and I have this one little star mark, and that is I think you engineered it actually, the deep view relative, the RMV. My star, it means the RMV is less than 5. I use the 50-day look back period. I can bring out the data panel real quick, and I have that RMV right out to 100.
Yeah,
because at the time it was probably at 0.
Yeah,
and Connor and I are starting to find, and we're still looking more into it, and to find a quantitative way, maybe to build a screener with an RMV less than 10 or something, because I've noticed so much of the best entries come after the RMV trigger, and it's amazing. So we buy this here, not a low that they stop. We do more of a previous low that they stop, and there's a little bit of frustration at the end of the year. It comes back in on us, finds support the 10, continues to find support.
Tightens up again, low volume.
Yeah, it holds or stop perfectly like this previous low today, 10 EMA area, and really consolidates. In hindsight, I was thinking about adding on this day, but we just didn't. It was, I think, the first trading day of the year, and we just wanted to take it a little bit easier. But it's funny because sometimes you're like, take it easier, and then all the leaders break out. There were many other opportunities that broke out this day, but we already had a position. We're quite content with it. And again, the best trades, I mean, I think this entry is actually even better than the entry we had. And from there, it just worked right from the start.
Yeah, I love the expansion. We have that first day of expansion, gap and go, and then the tight day under the overall base pivot if you move forward one day.
Yeah.
And you might say, oh, it's red, it's going to reverse. But it held close to that close.
Yeah.
And then I think there was another catalyst the next day that even exploded. I think NVIDIA at CES mentioned it.
Something like that. There's another catalyst that sets it higher. And you could definitely add on this day too over the 300 Livermore level. Again, we elected not to. Just wanted to let our positions work, under trade a little bit, especially earlier in the year. And this is kind of a principle in portfolio management I got from George Soros and Stanley Druckenmiller. They talk about starting the year, resetting each year, starting the year slower, be more incremental, sizing smaller. And once you build some of that cushion, most PMs will sell, lock in a good year. But when you do gain that traction, you actually want to do the opposite and push it.
Yeah.
And so that's kind of our mindset heading into it. Smaller sizing. We don't need to go for the, as Soros said, the jugular or go for the home run at the start of the year. We want to, again, think risk first, the drawdowns first. We'd rather not go into the red and be in a position of weakness. Now, we were in the right themes and names. We'll cover some other names we're in after this. And so we built a little bit of cushion. We're up about 6% on the month and the year. So now we have this cushion. We're starting to see the market's breath kind of deteriorate a little bit. And our focus is the drawdown. Make sure we keep our gains, because then when the market turns out, we can continue to compound on it. And Connor and I were talking about it the other week. 2.5% a month is about 35% for the year. And I mean, from portfolio management standpoint, that's a world-class year. So that's kind of our mindset right now.
Yes. And getting more into this SNDK trade, like I think this and the SLV short, were the two very best opportunities of this year so far. And we're recording this on Feb 1, just for context, everybody.
Yeah.
And this SNDK, I think we were talking this a little bit yesterday with the guys, is like, this is the best opportunity. You kind of you need to be creative and almost force yourself into the best stocks.
Yeah.
Like, the entries matter and you need to manage risk.
Yeah.
But you have to be creative and find entries into the best opportunities. Sometimes when it's uncomfortable, like this 300 level.
In hindsight, I should have added on January 1st to put my opinions aside about, earlier, but like, and it was
everything's in hindsight.
Yeah,
well, like,
it's hindsight.
There's lessons to be learned here, that when you notice the power and the characteristics were there, like, those are the trades to try to be a little bit more creative,
exactly,
get more size. And like, I'm talking to myself too as well.
Yeah.
And I think it's just a good lesson for everybody.
And in the big winners, you want the biggest size. For example, if we did pyramid to 5 to 7.5, it would literally made the year almost in just one trade.
Yeah.
But because we had smaller size, it has done pretty well, but it's not like a year game-changing trade. Yeah, it's just a nice little, maybe double
get you started
to get us started.
Well, building that cushion, building that momentum here. Yeah, zoom out and show any partials you guys took.
Yeah,
because it's a major move, and then obviously this last candle, I want to talk about it. But like, break us down those first.
Okay, so this is igniting candle, nice volume, and then this is a true igniting candle out of the base into all-time highs. And you read William O'Neill's book, Minervi's books, Livermore's books, Darby's books. Typically, most people in business school, they want to buy low PE stocks. This PE is probably beyond. Well, actually, I'm not sure what the PE was, but I think it must have been pretty high. And especially buying new highs, you feel it's so extended. It's made a 400% move. Many people think, like, how much more can it go?
Yeah.
Well, the answer to that is the best leaders can go far higher than anyone thinks. And actually, I saw a lot of people on Twitter shorting this into the left side level. And it's actually a good thing when you see not everyone agreeing on that idea. And then again, like you said, catalyst through Livermore level. Oftentimes Livermore found when you break that 100, 200, 300 level,
that clean level,
it usually is a quick push to 350, which is, exactly what happened. And again, just super linear trends, very controlled. We took our first partial here because it was about 60% gain. It was getting a little bit extended. It had hit, I think at the highs of the day, it hit the 10 ATR above the 50. And that's when I elected to sell it. It was a very small sell, 15% or about 14% of the original position.
Yeah.
Continues to trend, more 10 ATR signals here.
More expansion.
But still relatively controlled. If you draw a upper trend line, it's still relatively controlled. Quite tight. Opens equals low, which is what that yellow circle represents. But now we get another expansion day. It kind of penetrates the upper trend line a little bit. And then that's when I sell 43% of the position at 487. And now more 10 ATR extension signals. But I know the characteristics of the stock from before, that you can have very extended moves and it's still pretty controlled.
It's all above that shorter moving average.
10 EMA. Yep. And you have this little shelf. So I want to stay patient with it, continue to trail it. And heading into earnings, we're comfortable holding it because we're about 50% out, maybe more 60% out.
And a great cushion too on the position. Yeah.
And it gaps up. It's just amazing earnings. I believe the guidance was 3x more than expected for next quarter, double beat and raise. And it capped up like 20-something% at the highs. Let me just move the chart a little bit. And at the highs, instantly in my head, I was thinking, I'm looking for more trims, especially gold's going parabolic, silver's going parabolic. There's a lot of froth. Now, this is truly breaking that upper trend line if you draw that in there. And it was a 168% move so far. It was 400% above the 200-day. I don't think I've ever seen that, even with the other parabolics we've traded, SMCI, NVIDIA, MSTR. I don't think I've ever seen a 400% above the 200-day and a 20 ATR above the 50-day. So can I zoom into a 5-minute?
Yeah, go for it.
So on a 5-minute chart, what I was looking for literally was just, I knew I was going to make a trim that day. My mind was, I'm going to wait for the first 5-minute candle to close. It's called 5-minute opening range highs or 5-minute opening range lows. Right. I saw this first 5-minute here. We push higher, reject pre-market highs, and we don't short for clients because a lot are retirement accounts, but that would be a perfect place to start mean reversion short. I can't talk about the personal, but I might have done it there. Reversed my long to short, but we won't get into that. Let's just going to focus on clients. But that would actually be a perfect parabolic short entry. We were talking about with Ariel too. The pre-market failure is a nice place to get a position. The next area to potentially add, and for me, this was the trim, was through the 5-minute open range lows. So that's where I sold another 14% of the position at 647.81. Now we have about, I think, 29% left over.
Of the original.
Yeah, because the share count is so high, so we can't be as incremental. I probably have less, but it's just you have to decide whether to be even more out or be in. And I mean, it was just a trend down day pretty much. So that's kind of how I zoomed into the intraday charts to time that entry. And it was like a nice little half Livermore level at breaking 650 as well, and opening price and the 5-minute open range lows. So those are 2 entries to enter if you want to go short too. I was using the parabolic short entry as my trim, and you can add against a VWAP. You can add against I didn't even test VWAP. It was that weak. So you just take those entries and live with it.
Yeah, it'll be interesting to see what happens next. And when you watch this video, you guys will know it happened. But, maybe we get more consolidation here, some more pullback, but it's still above those moving averages. Yeah. So you want to play those outliers as much as you can. Yeah. So is your last sell on a break of a moving average?
Break of the 10 EMA.
Break of the 10 EMA. Yeah.
And even with this day, you didn't even break previous lows of the day.
Yeah.
Sometimes, I think that's more of a day trading technique. I've seen a lot of day traders say, just trail previous low of the day. I just like the moving averages more. So we're just going to wait for defensive sell for this last piece. This probably, who knows, anything can happen, but this probably requires a new base.
Yeah. We'll see.
We don't know.
Before this earnings move, how are you guys trailing? Did you have a trailing stop in from that last bit of the position? How are you kind of moving your stop up as it made progress forward? We were just watching
10 EMA. Yeah. Or 8 EMA. We could go to the 8 year.
Yeah.
Just rise the 8 all the way up, rise the 10 all the way up. We just love those types of leaders.
Yeah. Look at the volume during the base and on the breakout. It's just text. This is a great base to study. Like the NVIDIA one we talked about. It's a shorter base, but it's still got those tight areas, volume decline throughout the base that we're looking for. So all those characteristics.
Right. You can see volume dried up on the tight days here where RMV flash less than 5 is some of the low before this igniting candle, some of the lowest volume in the entire base. Volatility contraction pattern. Maybe I'll just highlight that real quick and we go on the next one. You can see the first contraction was here.
Yep.
And then the second contraction was here.
Yeah.
It was so tight. Perfect. Igniting candle on huge volume, on pretty big volume. And it just floated higher on lesser volume, which is fine. And with climactic type moves, I'm looking for the largest daily candle, largest daily spread, many days up in a row, break of upper trend line, extension above the 200, all these William O'Neill sell signals for extensions, and then usually the biggest volume since sun move, and it happened on earnings too. So, and a lot of times we talk about this too with Ariel yesterday with Christian. A lot of stocks where assets bottom on the worst of news and tops on the best of news. I'm not going to call a top here because that's not what we do, but we'll see.
Yeah, you got a piece and it moves higher. You took great profits if it moves lower. Yep. So yeah, I think this is a great lesson in position management and outlier identification, outlier potential identification, right?
Yep.
That linearity in the prior move.
Yeah, there's nothing new here.
Yeah, yeah.
We're kind of just riding, standing on the shoulders of giants.
Yep.
And learning what they did. We might have little artistic entries and exits, but the main principles are pretty much the same.
And identifying the key stock is is half the battle.
Yeah.
And then it's the entries, risk management layer on top of there.
And now back to SPACs, just real quick. That was not based off timeless principles. That was a temporary edge.
Yeah.
What we're talking about here are timeless principles. You go back to the early 1900s, and that steel stock Livermore trade. I forgot exactly what the name was.
Bethlehem?
Yeah. Bethlehem Steel. Same characteristics, high tight flags, nice price and volume. So it's the same over and over again.
Perfect. Yeah, let's jump to the next trade here.
So gold. Whoa, why does it look so weird? Oh, it's because of the move. All right, we'll back up here then. So I'm seeing before we saw this base and we thought about buying it, but in this area, in our minds, it feels a little too slow. It moves 1.5% a day. So we elected the pass. Gold was probably the best cup candle you've ever seen. 10-year cup with handle. It's still in this move, 2 years into this move now, but I'm going to skip that longer term perspective. We saw this base, and gold has moved very linear. Again, there's no earnings and sales, but we're willing to trade a commodity if it hits that story. And a lot of the story, there's a lot of narratives around gold, government debt, geopolitics, move away from the dollar, mistrust of government. We want hard assets, inflation, the whole
end-of-day trend.
Yeah, the end of the day trend. We like to take all these narratives and just understand why, but at the end of the day, price and volume, linearity, and obviously gold's liquid. It's one of the biggest assets in the world. So we see this linear move. We crack down here again. Let's call it your base starting bar. Expectation breaker. You close at highs, 10 ATRs. Above the 50, probably more. We have this kicker candle, close below the 10 EMA for the first time, and it leads to a new base. Again, the 10 is below the 20. I'm not interested. I see some tightness here with the RMV flashing. Again, still not interested, but we reclaim the 10 and 20. I'm starting interested again. Keep it on the radar. Gets below the 10 and 20. And I'm watching this tightness form here.
Can you zoom in just a little bit here on the recent pace? Yeah.
Why is it so hard to do this?
Because the last up.
Yeah. So you see right here, is that better?
Yeah, that's good.
You see how tight this is? At the same time, the RMV's flashing. Again, 10 is above the 20, above the 50, 100, 200. 150, 200. All rising now. I'm seeing this inside day, and we take our first, this is marked poorly. We take our first position. Actually, no, we actually took our first position here, and it wasn't the best of timing. And then we added on that day too.
Yep.
We added 2.5% on 11.9, added 2.5% on 11.24, and another 5% on 11.24. So we had a 10% size. It's a slower name, still commands risk in that 20 basis points area. So
good stops of these. Are they low of the day, or are they a little bit
low
on the moving
average?
Low of the consolidation.
Coincide with the 20 as well.
Gotcha. Good to have confidence there. Yeah.
If I bring up the 21 EMA, it's right there too.
Yep.
I know you use that. Just like the low and the 21 EMA area.
Yep. I love higher lows in the base against the 21 EMA compression.
Yeah.
I love to see that on lower volume.
Yeah. It's perfect.
Yeah.
See, this volume is low here too.
Yep.
And so we push out here, great action. You could say it's maybe low cheatish, whatever. It's just a consolidation.
Constructive.
Yeah, constructive. The naming doesn't really matter. So we buy out that. It rejects this in this area, goes for another consolidation. And I love the stair-stepping fashion. It allows adding very easily. I think at this time, this is really a pointless sell, but we push out and then reverse back in relative to this one high. I believe because we had 7.5% in Nugget at the same time. We just want to take a little bit off to buy other stocks, just more portfolio management, because we still had 8%, 7.5% left in gold, and then we had 7.5% in gold miners, 2x actually. So that's a lot of exposure. Yeah, a lot of exposure to the gold. Yeah. So we're fine to take off a little bit of the slower name. We break out of this, you can call it cheat now, another constructive consolidation pivot. We push out, gap up into this left side high area, and then sell off. Again, in that 400 or more area, we just took another 2.5 off, kept the 5 because we had the gold miners. And to diversify into other areas of the market. I believe, let me see when silver broke out. That was 25, 26. Yeah, so that's another reason why we took some off, because we had silver, which was faster too, another 2.5% silver. So that's our precious metals bucket. And I mean, they kind of look like random cells in a vacuum, but I just want to provide context. So we break out, negative expectation breaker here. I'm like, okay, this could be a failed breakout. I don't have the futures chart up here with me, but that's probably a little more accurate. And then we consolidate here, reject the left side peak again, and then we close below the 20-day. I give it a chance because it held that other day's low, this December 29th low. I'm trying to zoom in. And so we're giving it more of a chance. But for another reason, we kind of got it. To me, it's I think the futures maybe closed below the moving average. I don't quite remember. But then again, we're under a little bit of heat with the gold miners too, and we had silver working. It kept rejecting this left side peak. We had 4 days in a row just closing near the lows, so we just took another piece off sure enough, it just works and goes. But we're still happy to have part of the position.
Yeah.
At that point, we started to trail the 10 EMA, and you can see it just started accelerating. I don't like the GLD chart because the gaps aren't truly gaps because of the futures chart. I can bring up trading view. That is fine. Does it show up? Do you see it?
Yep.
So the gold, you can see it's definitely a cleaner chart because futures trade 23 hours. But that's the candle. I'm like, okay, something's failed breakout, rejected again, undercut, reclaim, and then this next day we rejected 4,400 again, and that's where I made that trim. It looked random on the GLD, but this closed below the 20-day, and then next day a positive expectation breaker, and it just trended all up the 10 EMA, and now I'm seeing 1, 2, 3, 4, 5, 6, 7 days in a row green, large daily spread, a gap up on the futures above 5,002, and then it put in the top on this day so far. It was the first day. It doesn't have the signal now, but near 5,600, it was the first flash of 10 ATR extension above the 50-day for the entire move of this year move.
Wow.
And I was like, okay, I'm trimming more. You can see volatility and then expected this huge downside day. So that was GLD. You can see sound the strength here, and then we sold the rest on the close below the 10 EMA, and futures lose a close below the 10 EMA as well.
And this, of course, coincides with that silver's goes on.
Yeah, to go even more parabolic. Yeah. Kevin Warsh, a more hawkish Fed chair, is put by or nominated by Donald Trump or President Trump. And then the CME also raised margin requirements. So there's a whole elixir of factors that led to this volatility.
Right.
People are over leveraged. You get margin calls, and it leads to this huge move. These moves aren't normal. So that is gold.
Great.
I'm going to quickly talk about GDX. We had Nugget. Oh, wait, I marked on Nugget. So I'll just talk about Nugget. But just remember, Don tells us all the time, do the analysis on the underlying, not the leveraged, but I'll just talk about it on the leverage for market purposes. It was just a simple 2.5% buy. It is a faster name, and we had gold at the time. Right here on this one tight day, after this reclaim of the 10, 20, and 50, just started a position there, worked immediately, and then it pulled back, found support. This is where you turn a previous high into support. RME flashed. I bought here, squatted. The next day, sold a piece. I don't know what happened to my other markings, but I remember the buys. We trend up again, so I'm stocking it again. Rejects this left side high, puts in this handle again. Another 2 days of RME less than 5. I add on this day, it squats, but my stop's at the low of the range. I add another 2.5%. So this is the day, December 19th, we have 7.5% size in Nugget. It works. I'm like, this is stellar. It's working. And then that one day right here, that's like a negative expectation breaker. On Nugget, we gap down back into the base. What day was that? December 29th. I'll go to GDX for the underlying. Right here, we gap to the top of the base. So I still give it a chance. More recloses. And then this day, this did shake me out of, well, so I added around 5% size here. My stop is lows. So hit the stop, I'm getting out. I'm not waiting for the close.
Yeah.
I will wait if I'm in a profit for the close. But I end up, you could say, part emotional. This is where the mistake happened. I had a position from here, which was still in a profit. I should have been more incremental. Got rid of that 5% size and kept this. But I think there's a lot of volatility that day, and there's a lot of things going on in the portfolio. I just cleared it just to clear the mind.
Yep.
In hindsight, I should have, and based off the rules, and it kind of broke the rules, I should have waited for a close below the 20 and at least a close below the left side high here with this 2.5 piece here. Yeah. So I like, that's a mistake. I don't want to just show winners. Yeah. So that was one where I got stopped out, and is a 31% move on GDX. So you can do the math on Nuggets, a 60% move.
Yeah.
Far greater gain than what we had in gold. Yeah, so if I somehow stayed at even that 2.5% size, it would have been great for the portfolio, but it happens. Just getting a shakedown.
Haven't you learned? Yeah. If you don't feel dumb sometimes, we're not managing risk.
Exactly.
Intervini says.
Yeah. So silver, I'll go quicker because it's the same, similar trade, but the move was incredible. I didn't see silver doing this. But the reason why I also took a position in silver, I believe I bought silver on this day out of the flag. One mistake was not, again, he said the best leaders just go right from the start. It was not adding more into all-time highs. I should have pyramided here.
It's tough to manage risk
Yeah,
on that. So,
exactly. It is tough. That's why I didn't do it.
Yeah.
But it looks like a gap. But again,
on
silver futures, though, it was much easier to manage the risk.
Right.
Like, you could have just had moved the stop to 10 EMA or even previous low of the day, and it wasn't wide. It was about 5.5.
Right.
So that's why I always say
size lower.
commodities, look at the futures.
Right.
So I'll just go on the futures now because it's better. Pushes up immediately. The whole group's working. Again, so linear.
Tight flags.
So linear. Just continues to flag. Trends super nicely. No acceleration. And then this is the area I'm like, okay, we're starting to breach the upper trend line. It's getting a little bit extended. Another tight day. We have this day that 10 ATR flashed.
Yep. We
trimmed some on this day. Next day, huge bearish engulfing. And in my mind, I was thinking that the base starting might happen on huge volume too. But it keeps holding the 10 EMA. Again, undercut reclaimed it. Continues to hold the 10 EMA. So I'm still in it. Undercut reclaimed the 10. Undercut reclaimed the 10. And now we break out again to new all-time highs. Shorts are getting squeezed at this point. Longs are probably adding more leverage on the long side. And eventually continues to trend above the 10 EMA. This acceleration happens. I trim a little bit off. Also flashes the 10 EMA. The 10 ATR extension. And like it's just an incredible move for silver. 130%, 120% move for silver, which is ridiculous. Like it was like a 4 or 5 trillion market cap. 130% move on that, like in a 2-month period. So we're almost all out of the position here. We have maybe 12.5% of original left, and it's starting to trigger. Then the elixir of factors, where multitude of factors happen, and I pretty much in my head knew the move was potentially going to be over. And I just wanted to follow the rules because with this type of volatility, you could have just closed all the way up here. Who knew? So we just closed out the rest of the position under the 10 and 20.
And then we saw what happened Friday on the breakdown.
Yeah. So
yeah,
silver.
Yeah, that first shake.
This one right here.
Yeah, it's gonna play game. It's gonna play games with people who are long, we all short, and then it recover. It doesn't fall through lower from that bar. So yeah, that's just something an observation I'm taking from that. Yeah.
And then another piece was we saw the group working. We saw there's government shutdown fears. That was kind of a catalyst in a way. No data. So people are getting a little scared of the government being shut down. So more people headed towards hard assets.
Yeah.
People are kind of still a little worried about inflation. And then why we wanted silver too is because I believe the ratio between silver and gold was the most stretched in its history. It was like 80-1. And so that led to like sort of a mean reversion in that ratio. So that's something to look for in terms of gold and silver trades, that ratio of gold and silver. Cool. So, okay, now let's go over REMX. Very similar trade to like SanDisk. A big linear move up. Rare earths has been a very big theme. Lithium, all those rare earth minerals for the build out of AI, the chips, like really everything in industrials. And we see this big linear move. I found one of my favorite setups is you have stage 4 decline. You break out into stage 2 uptrend, a linear move, and then I love the first multi-month base. So again, about 5% size here on the break of 75. It pulls back in, puts me a bit under some heat, but it holds my stop. Again, the breakout happens on January 2nd where we were taking it easy. I should have added there like SanDisk, but then like would have changed the year even more if we did pyramid. But these are some perfect buys. And I knew it was perfect buy, but we just already had a position. RME flashed.
The market was iffy at that time.
It was iffy. Yeah, it's hard. Yeah.
It's tough. It's in hindsight, it's like, should have just bought. But that's why those entries work. Is like it caught everybody off guard because I remember I was expecting us to roll over a little bit more based on recent trade feedback, all that stuff. So it's tough. You, as a trader, like you have to be water. You have to be quick with being water. So like it's tough. This is real trading. Like you're gonna miss stuff and not get a full position on or miss. You're gonna miss leaders.
Exactly. Yeah. Again, RMV flashed less than 5. It's probably at 0.
Low volume.
Volume is some of the driest ever. You can see a lot of green. Pocket pivots. Yeah, pocket pivot volume. You break out in just a super linear trend. The first 33% trim was at the 10 ATR extension, the gap up to, and we close the rest below the 20. Very simple trade. PL, a different trade, still a big linear move, from an episodic pivot based, and then another episodic pivot, just a simple, opening range break. It was just huge for like guidance, raised fiscal year revenue to about 300 million, consensus 284. So I bought it pretty much into all-time highs, pull back, continues to hold a 10. I have this one anchor view up on earnings day. I kind of like putting that in as well, but it's less part of my process. Trends above the 10. We sell into, so for some reason, I had an indicator flash. This was 10 ATR. It was also the measure move, which is highs to lows, about 6.3 points. This is also about 6.3 points. It also hit, it wasn't 10, but it was near 10. So I decided to just trim a little bit off there. I believe it was a 33% trim. Continues to trend against the 10 EMA. This day right here against 30 level, we gap up. Again, it was, like 13 or something ATRs above the 50. I did another trim when it fell back into 30, and then we're still holding the rest of the position. I'm just waiting for a second close because it was right at the 20, right at these lows. And I found sometimes with these flag-ish basing formations, you have a kind of scary day, and then the next day just comes right back into the formation. So those are 6 trades.
Yeah, and you've got good cushion on this one, so you're trying to give it that. And zoom in a little bit after that gap, because there's like an HVC claim. HVC, of course, the close of the gap up day. There was like that
HVC.
Yeah, so like there's the bad bar down that breaks HVC, and then the next day is like tight, and I think reclaims it. That could be a potential ad spot. This is like my analysis for my process, but I love buying it first day is like, that's great. Like that's awesome. Some people aren't comfortable with that. I actually prefer like a range or tight area or something like this after the gap up day. I feel a little bit more comfortable trading that. It's right near the base too.
Opens equals low and double opens equals low.
Nice power right after reclaims push.
And so this is that Magic Elixir liquid, high ATR, super linear move, space theme, narrative, fundamentals, catalyst. It just had everything. Price volume, relative strength line broke all
new highs.
It just had everything with the Magic Elixir.
Yeah, perfect. Yeah. Talk to me a little bit about, like, obviously we talked about the Elixir. What are kind of your routines to identify these in real time? What are your kind of processes? Talk to me a little bit about, how you actually put into practice.
So I'm using a DV leader scan, but every day I'm looking at up on volume scan, down on volume. Most big catalysts end up on the up on volume.
Right.
I have the HV daily scan, which is, it scans for highest volume ever, highest volume in 1 year, highest volume since IPO. So a lot of big catalysts will show up on this as well. Then I have a 5-day 20% plus move verse. That's like that first burst. Again, most of the big winners will show up on that too.
And then you catch the tight area.
Yeah, I could argue I don't need all these screeners. I could just have my one momentum scan, but I just like a smaller, more specific screen just to see what ends up on there. Then finally, I have this momentum scan I made. It's really kind of proprietary, the deep view, little plug, because I have just simple volume above the 50 price, and then I have this logic where it's any of these 6% ADR, 5-day, 10-day, 20-day, and then another logic which is in a 1 week basis outperforms 97% of stocks on an absolute basis, and then 95, and then these aren't even needed, but I just wanted to put them in there just to make sure if the first 5 don't catch it, but it usually catches everything. And I just scan this every day. Probably sometimes unneeded, but I just like going through the process and seeing what's on the momentum scan. I've noticed when this scan, and I hope DeepView adds this, I talked to Ryan Ross, where you can plot out the number of stocks on a scan and create your own little universe oscillator. I've noticed when this gets super extended with so many names,
it's later in the cycle,
especially when names are going vertical. And then recently momentum bottomed on when this dropped around 100 names. And then it started turning back up. So I would love for that feature. Ask why not. And then I just go through DB leaders every week as well. And then there's some other ones, but I won't talk about it. I go through those. I use like the color coding. So I have like different portfolios. I track what Don has, obviously what we have. Then I manage a smaller set, individual set. Connor and I both have an individual set we manage, or just friends and family. That came with us super early on, but all new clients go into Turbo now. I have my personal, I have a focus list, a weekly watch list is what I think could potentially be ready in the next week or two. And I clear that every week and reestablish it. And I just have a watch list of strong names. I have another list where I love the deep view mini charts. I can go through like 300 names just scrolling. Like our eyes are conditioned I just look across the page, scan it. If something's interesting, I can't see the full picture. I don't have the data panel. I don't have weekly charts. So I'll just go here
And add it to
puts the mini chart results, and then I'll go through that in more detail.
Nice.
And then refilter back into my other list.
nice workflow. Yeah.
I have a short watch list, which doesn't have that many. I don't short that many stocks, but when I start seeing more stage 3 and the stage 4, like Palantir actually should be on this list. I'll put that there. And if this list starts piling up,
Now it's going to bottom, Ted. You
I-
bottom Palantir.
yeah, so you should buy it tomorrow, Richard. And then I just have this combined position list between Grow, Turbo, MySet, and Personal. I have it set on pre-market with some pre-market filters just to see what's gapping up and down, and then the universal one, just seeing what's moving.
How long does your daily process take to
Daily, like
market?
when I'm efficient and not getting distracted with text, like I can get it done in the third, just like 45 minutes for the scanning, or 30 to 45. But it'll take longer when I want to dig into fundamentals more, and AI helps a lot with that. And we could dive into that a little bit.
Yeah.
So I'm using Comet Browser right now. On the assistant side, I have a few shortcuts that help a lot. Well, they updated this. Wait, hold on. If you do /, I have / and news, and I'll show you the prompt right now to anyone that wants to copy it. This is a shorter prompt. Just why did this stock make a strong move and or gap up today? Put in a table of all the news in the last 3 months, provide any themes this stock is a part of and competitors. When I'm really starting to get interested in a name, I have this bigger one. I posted on Twitter before as well, and it's called Stock Description. And perhaps we can link this either in the show notes or I can share it again on X or something.
Yeah.
And this is huge. Just explain to me what this company does. Like I'm 12, professional summary, max 10 sentences, all of these characteristics, hot theme, catalyst, significant fundamentals in the table, show all major events in the table, maybe mention any insider buys or sells, institutional filings, summary of the stock and how it's moving against competitors. You see what I mean? Like pretty much the magic elixir.
Yeah.
And then I just say overall focus on the reasons why I can make a big move in the future: earnings, sales, guidance, product launches, analysts, upgrades, downgrades, CEO, founders, executive team. I'm talking fast because I don't want to like be slow on this. And then it just gives me a huge prompt. So maybe I can try it once.
Sure. Over it.
Let's just do it on Planet Labs. I just literally go here, stock description, and just let it run. You can call it an AI agent. I still don't fully consider this an agent. It's kind of agentic because it's working on its own, going through all these websites. But it's more of a simple agent, in my opinion, like Cloud Code, Cowork, Cloudbot, or Moltbot. That's more of an advanced agent, which I haven't checked out Moltbot. The security kind of concerns me. Cloud Code is great
today.
Yeah.
So yeah.
But you can see, look, it goes through. Like here's all the logic. It goes through all. Like imagine us doing this by ourselves without AI. This would take maybe 30, 45 minutes just for one company. And now it's taken 20 seconds.
Yep.
It goes through all of these websites, Zacks, even some X pages. Yeah, finance. I don't know why I went to GitHub, but I did. Went to the company's website. Looking at Rocket Lab's Black Sky, NASDAQ. Like, look how cool that is. It's still going. And then boom.
Nice.
And then you can just click up here. Then open a new tab as well. I don't know why it's not working. Oh, because it's still generating.
And on a day-to-day basis, in addition to screening and researching these individual companies, do you do any like journaling and any methods for that?
Definitely. I'll show them exactly what I do. This is my daily journal. I before pre-market, I'll like just close my eyes and I have all these memorized in my head. It's just like reminders. So like I've the serenity prayer, like God grant me the serenity to accept the things I can't change, courage to change the things I can't. No, sorry. Courage to change the things I can, wisdom know the difference. I repurposed that into a trading one too. So like God grant me the serenity to accept that the markets will do what it wants, when it wants, regardless of what I want. And I've found that I've been doing that for a few months now. And I found it's brought me a lot of peace in terms of accepting the markets will do what it wants, right? Whenever, and I can only focus on what I can control, which is once I'm in a position, it's just where you sell.
Yep.
And that's all that matters. Like the stock will do whatever it wants, and you just focus on what's normal, what's abnormal, and just only be afraid of abnormal action.
Right.
So that's helped a lot. I've kind of taken this page of Marx Aurelius where journaling is about journaling your own thoughts, any thoughts, and then also don't be ashamed of copying people's quotes and having it in there as well. So like you see on this journal, I don't know if you can see it, but like there's from the little book of Market Wizards, I think Bruce Cumner said undertrade in terms of size and frequency. So I have that there. I have a lot of Quality McGee quotes because I just love Quality McGee's like wisdom and the way he frames the quotes. I hope you might have to block that out. But like whenever I miss something or mess something up, I'll repeat this in my head. This is a Livermore one right here. This is like, I have these quotes because I've realized patience is probably one of the most important virtues in trading. So Mark Weinstein, who's a market wizard in the first book, has a cheetah analogy. I also like the sniper analogy from the unicorn sniper and unknown market wizards. And then I have I think I have Buffett's baseball analogy with Ted Williams.
Yep.
He divided his batting zone. I think I don't know baseball that well into 77 jukes. And he found there's certain areas where he hits a .4. And I think he's the best hitter ever. He's the only one to ever do a .4 in the season. And then he found other zones where he hits a .2.
Yeah. So much worse batting average.
Yeah. So he waited for his fat pitches. Exactly. He's willing to take pitches. But the beauty of the markets is I have in my focus list. This is also a Buffett quote. There are no called strikes on Wall Street. You can watch as many pitches as you want and swing when things set up your way. So I have those quotes that I say in the morning. I have like a pre-market thoughts area. So, every day at Revere, either me and Connor have to lead a daily brief at 9 a.m. So these are like the sections, S&P highs and lows overnight, what the bond market's doing, any economic data, earnings news, notables, upgrades, downgrades. And then I have this little thing here where it's like, what can I do today to achieve peak performance, review my strengths and weaknesses. I took this from Pradeep, are breakouts likely to work, just like a situational awareness thing. I look back at the previous day to review and then answer that. I have a personal trading model, kind of took it from Minervini, and I'll highlight this yellow, green, or red. I look at my feedback, like breadth and length of the focus list, and I'll give it a green, yellow, or red, or orange. And then I'll maybe make a note, but sometimes I don't. And then this is just a copy and paste from the previous day, like an expectations.
And all this is situational awareness, basically. Yeah.
I'm trying to force myself to have more situational awareness because I realized that's probably one of the most important things. We know how to get in the big winners. We know the entries. And as long as you save your mental capital, financial capital for the right environments, it should feel easy. So that's pre-market. I have my focus list from the previous night here. I try to audit every single name through these 5 points.
Mm-hmm.
This is from Interview too. If you had 10 trades this year, would this be one of them? Sometimes I feel like that's a little too selective. So sometimes I'll ask myself if I had 10 trades this month, it's like a little better. Because like, it's like, am I really going to only take 10 trades? It's like, I'm like kind of lying to myself because I know I'm going to take more than 10 trades.
Yep.
And then Magic Elixir, if I did this 1,000 times, this just conditions me to make sure I'm focused on process.
Yep.
And not like, Annie Duke, who wrote Thinking Bets, she has this quote, and don't judge your decisions based off the results, judge it on the process. And that's why I ask myself that. And then, is it a fat pitch? Because all our best winners, you look at the screen, you're like, whoa, like that's so great. Like the PL's gapping up those trades I showed. And it's like, I found all my best ones are like, to me, obvious now because I've studied enough. And there's ones I'm trying to be more self-aware of, catching myself, trying to force things. And if I even have that little gut instinct, if it's like something doesn't feel right, it's just leave it off focus.
Right.
And for me, I know some traders like to be more fluid. They have a whole list and they'll buy whatever. I like to have like what your approach to all you guys in that book is like, I can only look at what I have on focus list. And for me, that prevents me from overtrading and also FOMOing. Like some stock will be moving and I wouldn't know until the markets are closed. Right. You can't act impulsively.
And then if you missed it, you can think about, all right, did my process break down? Where can I improve?
But if you're just like impulsively buying, selling, whatever, then you don't even know if your process has a hole because you're just watching everything. Yeah, and I personally don't like that as part of my process. I have a market notes section, just literally any thoughts, what I'm doing, a portfolio update section, what I bought and sold, and then my portfolio and the client's portfolio. I'll have that there.
Yep.
It's just not here because it's in a different page. And then more quotes just more quotes.
I love the constant reminder.
Yeah. Regarding portfolio management, like as long as it's acting right, market's acting right, don't be in a hurry. This is the Livermore one. It's so important because I see everyone trying to catch bottoms and tops and like just lead to frustration, honestly.
Yeah.
Sell down to the sleeping point. I like that there because if there's something bothering me, just sell a piece of it. Then the first one is from Livermore as well. The real money's made in commitments that show profit right from the start.
Right.
And then I have a post-trade analysis. If you don't look at yourself, you're never going to get better. And you can see a lot more quotes. I'm like obsessed with like just reviewing quotes. And in my life journal, I'm not going to show it today. There's more quotes that I repeat every day. Because I think, I forgot who said it. It's one of the big philosophers who pretty much said like, whatever you keep in thought is like what your mind becomes. I think Marcus really said that. And so I just constantly remind myself with quotes right here. And so like these are two James Clear ones. You don't rise to level your goals. I have a Seth Klarman one about being consistently disciplined, rigorous approach, and just trusting that results will happen over time. Like if you have a bad day, just like that helps me stay grounded. This is the Andy Duke one combined with Larry Height. Good decisions should not be judged on results, rather on a good process. Good and bad bets aren't necessarily winning and losing bets. And I feel like, especially in the beginning and earlier traders, I mean, it's really like Pavlovian's dog, like, or like rats. They hit, like they sniff cocaine or whatever, and they get a jolt out of it. And then they touch like electricity and they're conditioned to not touch it. And this is why the markets will twist your mind in so many different ways, because you can make a bad trade and it works. And because at the end of the day, we're still we still evolve from, I'm saying monkeys. I'm not gonna get too technical. Just monkeys. Like if we do something bad, but it ends up good, we're gonna think that's good. And there's a lot of times where you're making the right decision and you get stopped or something happens and you're gonna rationalize and say that's a bad decision. So you can see how you can get twisted in so many different ways, right? Without having that awareness.
But it really comes back to system and process
and knowing what is a good decision, what is a bad decision. And as long as you're making good decisions, you should you first need a system and edge, but from that, as long as you're making good decisions, you can just trust that the results again will happen over time. A Robert Greene one, a reminder that mistakes and failures are precisely your means of education. They tell you your own inadequacies. See mistakes, pain as an indicator to reflect so you can grow. Ray Dalio talks about pain plus reflection is progress. And then again, this is like another sports reminder. It's just one trade. Like it's just one point. It's just one golf swing. Steph Curry has like the next play mentality. So I try to remind myself that. And then I remind myself that it's always the human side. This is from Livermore as well. And then this is from the book Awareness by Anthony DeMello. He's a combination of Christian, Buddhist, and some other philosophies. And this is from a Chinese sage. And this is a reminder to forget about the results and money. And it says, when the archer shoots for no particular prize, he has all the skills. When he shoots to win a brass buckle, he's already nervous. And when he shoots for a gold prize, he goes blind, sees two targets, and is out of his mind. His skill has not changed, but the prize divided him. He cares. He cares more about winning than shooting, and the need to win drains him of power. So that's another reminder that I have in like the post-analysis section. Then I have a post-market thoughts, more situational awareness stuff, short-term trend, long-term trend. Momentum trend's more subjective. Like, am I feeling there's momentum in the markets? Pradeep's market monitor, I'll look at that. So I'll make that green or red or orange. New highs, new lows, Nazi, Nizzy. And then from the highlights, I can see like, oh, it's like a bunch of red, yellow, orange, or green. And that's just like a quick little sign of that. This area might have not been updated for a little bit, but there's just like some dominant fundamental macro factors.
Right.
Fed cut rates, balance risks, labor market inflation, stress values, just question marks. Keep in mind. I note notable actions when I go through like the inter-asset correlations, stocks, bonds, commodities, crypto. And then I have a stock trading environment section, more reminders. You'll be in a drawdown 99% of the time. It's impossible to be at all-time highs all the time. And then I just say, if I'm ever struggling, rewatch the Colin McGee mindset at Trading Techniques. Just like a reminder, there's resources for me. More situational awareness. How are my recent open close trades doing? How much my breath is on focus list? So I make this like green, orange, red. I have a journal that kind of gives the stats for the last 5 to 50 trades. I can show that real quick too. And current positions, how are they doing? am I feeling frustrated right now? Have I earned the right to play larger? This is from Interveni. And then what is path of least resistance? Kind of a little more thing. All right, this is from that one little buck who moved the cheese.
I don't know that.
It's about mice, and there's 4 personalities of mice. It's like a fable in a way. I think that's the right word, fable. And it's like a little short story to teach a lesson. And there's a couple mice or rats that are super adaptable. They'll navigate the maze to find the new cheese. There's some others that just only go the same path over and over again because they found cheese there once. And that's like people going back to old leaders. Oftentimes when leaders top, they become laggards and there's new leaders. So I have this funny little thing. I read this book like 2 years ago. Where is the new cheese? Be sniff and scurry. Those were the 2 more flexible, adaptable ones. And then where's the money flow into it out of? Main themes. I'll maybe list a few here. Thematic inflows, outflows, my own personal trading model. That goes to the next journal. My bottom line expectations, that goes to the next day. And then tomorrow's focus list with all those quotes again. And then the weekend one is pretty much the same. I just have a reminder of the characteristics of my biggest winners after reviewing my biggest 20. And these are just some of them there. And that's pretty much it. The weekend is very similar to the daily.
Yeah. So for everyone watching, like if you don't have kind of a routine process, this is a good one to take bits and pieces and make your own, add your own quotes.
And I have Notion AI.
Yeah.
And so we were talking about this with journaling. I think you said you like to journal by, or that was someone else. Christian likes to journal by hand. Christian Flanders, who's also on your podcast. I've just always been more digital. And because of the advent of AI, I realized, holy crap, like this is data on myself for self-awareness. I have like a 2,000-day journaling streak for my life. And this is like 3-4 years now of my trading. And now with Notion, with their AI, I think they either use ChatGPT or API or one of the main frontier models. So I can add context here, trading journal, sources, not all sources, just the Ted Zhang Notion. Then I can say, summarize my strength and weaknesses from X date to this date.
Right.
Or I probably should do it soon. Summarize all the journals, my strengths and weaknesses, and then give me action steps. And because AI, LLMs are best for pattern recognition and be trained on or interpreting text, it's just amazing. I have all this text in here.
Yeah.
And so it's just...
That's a great way to leverage it.
Yeah.
Yeah. Perfect.
So I got to do this later, fill it out. But that's for this weekend, and then this will be for Monday.
Great.
So that is a bit of my process for, the markets and post-trade analysis. Oh, I got this. So actually one last thing for post-trade analysis. Let me go to the trading journal. So I have my calendar here. I took organic chemistry in college, and there's like the problem where organic chemists have to either start from a starting point and synthesize an end product, or in class, like super hard exam that most struggle with was you're given an end product and you have to reverse synthesize it with reagents and starting products. So you have to be able to map out like what pieces go into like those slots. And to me, that's like kind of what success is about. You identify your final vision or the trade, and you piece together exactly the pieces you want to get there, break it down to like the smallest step. Like I know in your startup world, it's MVP, minimal viable product. I'd say this is minimal MVA, minimal viable action.
Or MVP, minimal viable process.
Yeah, process, something like that.
Yeah.
And so that's the weekly journal. I have an end of month one, which is a little bit more expanded on the weekend one, just a little bit more questions to review and ask myself. And then I have a post-trade analysis quarterly. I have biggest winners and common characteristics, biggest losers, biggest misses, strengths. I just have some notes here for me. I got these from Naval. What requirements or assumptions I have about the markets may be false and taken from another book without verification from first principles. This one always makes you like sit down, because like sometimes this is a more of a question just to get you to think. You might not even come up with the answer, because sometimes you don't know what you don't know about your process. And then, a big thing over time that I've learned in mastering anything is about peeling back the layers so that only what is necessary is left. And that's like simplicity. Charlie Munger talks about it. Simplify, simplify, simplify. Naval talks about it. Getting rid of what's unnecessary. Elon has his like business algorithm that he talks about in Walter Isaacson's biography, where instead of looking to automate first, you want to first look like what are the requirements? Are there anything unnecessary? You eliminate those first because you want to optimize something that's unnecessary. So I just have a question quarterly. What is an unnecessary part of my process? What can be eliminated? And then this is a reminder from Naval, complex systems come from iteration from simple designs. Same with biology. Like our whole bodies are simple systems from, the circulatory system, the nervous system, the digestive system, the lymphatic system, and all those come together to create a human, which is a very, very complex system. So that's even how, like in medicine, you learn the separate systems and then you piece it together. So that's kind of like what all this is: risk management, position sizing, entry tactics, cell rules, all that. And your daily process, your post-analysis process, which there's some really good questions in there. I don't remember them because there's so many about post-trade analysis. Yeah. I'll probably actually take a look at those questions again just to run through as well. And then I have notes and then notable principles, which are like, I got this from Ray Dalio. He has like a principles guided journal, and the pain plus reflection equals progress is one of my favorite principles. And he says, Michael Jordan says this too, is like anytime you make a mistake, just see it as an opportunity to extract a principle from it or a lesson. And that's very valuable because
that's how we improve.
Cumulative lessons and principles will guide you towards success in the future. And yeah, like, again, when we started off with the Daily Stoic, with Stoicism about how you define like what stories mean to you or what events mean to you, one person could think like you lost a lot of money or you went through a huge drawdown and they gave up. They say, I'm a failure. They start identifying as like being worthless. But you can flip that on the other side and just like see that as only a learning system. There's no failure. There's just, I guess, stepping stones towards wherever you want to go.
Right.
Yeah. So that's that. And then I have an annual reflection. And so I'll look at for the weekend journal, I'll look at the daily journals, and those lessons go into the weekend. The quarterly one, I'll look at the weekend journals. It's like this like reverse pyramid, or no, a pyramid. And then I'll look at the weekend ones that goes into the quarterly, and then the annual, I'll look at all the quarterly. Right. It's kind of just like a stepping like a pyramid in a way.
Yeah.
With that annual at the top. So that's a little bit part of my process.
Yeah.
Yeah.
Ted, awesome. I mean,
I think we can do this again. There's a lot more to talk about.
We'll do more ones. This has been fantastic. Appreciate you sharing your whole process. One last question for you. If you have advice for, newer traders starting out, maybe they're struggling, what's kind of one most important bit of advice that you could give them to help, develop their system, develop their, shorten their learning curves?
I think before even getting to the markets, after like, I'm almost on to year 6. I started when I was 19. I'm 25 now. I would say you first have to, before even getting in, you have to ask yourself why you want to get in the markets. And it goes back to Robert Greene's mastery. You have to have that natural inclination for it, or else you're going to give up and quit, or it's just going to be very frustrating. So first, figure out if you have that natural inclination towards all the characteristics of being a trader, strategic thinking,
discipline,
love for human nature. I love like studying human nature, psychology, discipline, the competitive aspect, being able to handle losses. And from that, then you can get into the markets. And from there, I'd say you have to read all like the basic books, do a lot of personal work too, like make sure you get your sleep right, exercise, do a lot of self-reflection. It's not, I would say like this advice isn't trading specific, but I think you have to first start off with a why. I'll leave, I guess, people off with one more quote. I love quotes so much. I probably said so many. Yeah. Nietzsche, the German philosopher, he said, "He who has a why to live for can bear with almost any how." So if you truly have a good why, like the how, you'll figure it out. And yeah, I think that's it from me.
Awesome.
Yeah.
Well, Ted, thank you so much for your time.
Yeah.
It's been a pleasure doing the first ever in-person
interview with you. This is great.
This is great.
Yeah.
So thanks again to everybody watching. I hope you guys enjoyed. Leave a like down below if you did. Subscribe if you're new to the channel. Check out the links to, we'll link
Revere, Ted Zhang on Twitter, Revere Asset on all social medias, revereasset.com. And then, thank you. I appreciate this. This is really fun.
Yeah, cheers, Ted. To everybody, thanks so much for watching. If you're still around at the end, you're a legend. And we'll be right back with the next one. Cheers, guys.